we can start.
Good evening to all the members who have enrolled for today's session. Myself, CA Rekha Umashik, Regional Council Member, SIRC. I take the immense privilege in inviting you all for this first session on the FEMA series. This is a topic that is quite relevant these days, especially when we have lots of cross-border transactions and when we have to facilitate the external trade and payments, and also to know more about how to deal with foreign exchange when we are in India. So today I have the opportunity to introduce two great speakers who are specializing in this particular topic. The first session will be handled by Mayur Nayak sir, and the second will be by Pradeep Tulsian sir. So I would like to introduce our first speaker for the day, Mayur Nayak sir. Sir is a practicing chartered accountant. He is a PhD holder. So that is the first highlight I have to give about sir. Sir is a PhD holder as well as a practicing chartered accountant for the past 33 years. Over 3 decades, he has been into practice. He has been specializing in international taxation, including transfer pricing, cross-border transactions, cross-border investments, and foreign exchange, FEMA. He has passed both BCom in the first class from Mumbai University and is also a rank holder for the CA final exams. He has also done his doctorate on the topic Impact of GAR and Transfer Pricing Regulations in Tax Laws and Prevention of Base Erosion and Profit Shifting via Cross-Border Business. He was also the president of the Bombay Chartered Accountants Society, BCAS, for the year 2010-11. Presently, he is the chairman of the International Taxation Committee of BCAS. On 16th July 2011, he was conferred the Scholar of the Year award by the Neswadia College of Commerce in Pune in recognition of his contribution to the profession of CA in the field of international taxation. He has delivered his 43rd founding day talk at the Neswadia College on the same day in the subject Good Governance and Accountability, a Perspective. He has also co-authored a number of publications by BCAS and CTC, including GAR and MLI BCAS. He is also a co-author of the International Taxation column in BCA Journal for almost 20 years and was the recipient of the Best Feature Award in the year 1999-2000. He is also a contributor to the monthly column FEMA Update in the International Tax Review published by the Chamber of Tax Consultants, that is CTC. He has jointly contributed the India branch report on the source and residence new configuration of the principles on behalf of the India branch discussed at the 2005 Congress of International Fiscal Association published in here. And he has also presented papers, led group discussions and delivered talks at various professional bodies including BCAs, CTC, ICAI, Chamber of Commerce as well as public sector banks, and has contributed articles in various professional journals and newspapers in the areas of international taxation, domestic taxation, transfer pricing, FARA and FEMA. I take this opportunity to welcome you, sir. We welcome all you. And the second faculty for the day we have Pradeep, sir. Pradeep Tulsian, sir. Sir, welcome to this seminar. Sir is a fellow member of the Institute of Chartered Accountants of India and also an associate member of ICAI and ICSI. He has also done his DISA from ICAI and he has also done his LLB and PhD in Commerce from Gujarat University. After clearing CA in 1996, he has started his own practice under the firm name PGT and Associates, and he has been since practiced from 1996 onwards. And his expertise includes in the field of direct tax, indirect tax, company law matters, project finance, amalgamation and mergers, bank audit, corporate audit, internal audit, management consultancy, and he has been appearing in various tribunals like ITAT, CESTAT, NCLT, etc. He is also a co-opted member of various committees. He has been co-opted member with the various committees of WIRC and Ahmedabad branch during 2013-15, and also the co-opted member for the editorial board of WIRC for the Institute of Cost Accountants of India for the year 2021-22. At present, he is the deputy convener of the Gandhiram Study Circle of WIRC, which has been awarded the Best Study Circle Award for the year 2013. He has also delivered many lectures in the subjects in ICI, ICWI and ICSI. He is also associated with many organizations, including the Tax Protection Council, Ahmedabad. We welcome you all, sir. Over to you, sir, for the session.
1 minute. How? Let me share my screen.
Yes, sir. You can just keep your PPT and then you can start sharing your screen. And now it's displaying the Word document. So now a PPT. Is
it showing PPT now?
Yes, sir. It's showing the PPT now. You can start.
I'm unable to see it. 1 minute. Why can't I see the PPT here? It's not shown here.
Now, what is it visible to you, sir?
1 minute. Let me. Earlier. No, I am not able to see my PPT here.
Okay, what is it displaying, sir? What is it displaying? I can see. 1 minute. I'll just take the rights and give you the rights. You can you have the PPT on your desktop, sir? Now you just have the PPT on desktop screen. I'll just give the presenter rights.
Yes, 1 minute. Now let me show it to you. Okay, now it's okay.
Okay. Okay, now I'll just give you the rights now. You can.
Is it visible?
Now it's visible, sir. You can run through now.
Okay, fine.
Thank you.
Sorry.
Yes.
Good afternoon and welcome to all of you. At the outset, let me thank SIRC of ICAI for giving me this opportunity to share my thoughts on a very important subject. And I must thank CA Rekha Umaship for her kind words of introduction. And I must thank all the office bearers of the SIRC for inviting me to share my presentation on a very favorite subject of FEMA. So friends, today we are going to learn some of the important fundamental aspects of the subject of Foreign Exchange Management Act. And as rightly pointed out by CA Uma, that this is a subject of importance for all the professionals who are advising in the field of international taxation or even otherwise, because this is one act which is practiced more in breach out of ignorance, than in compliance. The reason being that most of the people are ignorant, and when they come to know about the contravention, sometimes it is curable, sometimes it is beyond cure, and they end up in heavy penalties or compounding. So it is always better, the prevention is better than a cure, and therefore, if we are aware about of basics of FEMA, even if we are not practicing, then it is good for us and even for the clients. These days, auditing has become a very onerous responsibility of chartered accountants, and whenever there are some contraventions, people look at what the auditor was doing. Now, auditor is supposed to look after so many things and many acts, and FEMA is one of the very important part of it. And if the auditor is aware about at least basics of it, then auditor can sense some difficulties, some problems, and then auditor can take the expert advice if at all required. So let's begin the subject. And the need for study of FEMA, as I already said, that this is the reason that we all need to learn the subject in detail. Not only for our own benefit, but for the benefit of the clients as well. And if the structuring done at the early stage, then it can save us and the client from a lot of hardships. Many times cross-border structurings are not reversible or not easily reversible. And I have seen deals falling flat only because they did not take care of the FEMA provisions. There have been incidents where RBI has asked the companies to wind up the operations, and winding up is not that easy. In fact, besides the compounding fees which are payable for contraventions, there could be a tax implications whereby the selling of the overseas ventures would have what has resulted in a lot of tax liability. So these are the important aspects which we need to learn as we go along the subject. I would try to educate you about some of the basics aspects as an auditor which you need to take care of it. There can be a separate topic on FEMA from the auditor's perspective. What are the important key factors which as an auditor you need to keep in mind while doing audit of any client. Suffice to say here is that it is important. There was a time when India pondered over scrapping FEMA altogether or say capital account convertibility. We'll discuss when we come to the current and capital account transactions and what is the distinction between the two. But today, let me tell you that instead of liberalizing on the foreign exchange front, the complexities have increased, and there are many gray areas where there are no answers. So I would only advise you that wherever there are such situations, one should take a conservative view, go to Reserve Bank of India, seek a clarification, and then proceed in the matter. The next is the scheme of FEMA. We'll see how the FEMA is designed, just 49 sections, and so one would feel that okay, it's very easy. We are used to reading 500 plus sections, and 49 sections are very easy to master. But it's not just the 49 sections. Like in income tax, we have a proviso and sub proviso and clause, and a lot of things. So here also there are notifications, sub notifications, and amendments, and press release. All that thing we need to keep in mind while interpreting this complex law. So if I were to describe FEMA in a nutshell, what FEMA tries to govern, if you understand the FEMA from the conceptual point of view, then it becomes very easy. So what FEMA tries to govern: currency, securities, and properties outside India in respect of person resident in India. So as a resident of India, if I have any property outside India, or if I want to acquire any property outside India, if I want to acquire a foreign currency, or if I want to acquire a foreign security, that is overseas investment, okay, then FEMA is triggered. Or currency, security, and properties in India in respect of resident outside India. Okay. And also transaction inter se between resident and a non-resident, because there are implications of any transaction. For example, a non-resident gives a gift to a resident, then what happens? That resident is receiving a foreign currency, correct? And therefore FEMA is triggered. Not only that, in fact, FEMA, the word itself is a misnomer in that sense, because even a rupee transactions between the resident and non-resident, FEMA provisions are triggered. So sometimes people come to us and say, no, but sir, I have not done in any foreign exchange transaction. It's just a pure rupee gift. I said, but then it is still, FEMA is applicable. So wherever there is a non-resident involved, either it is NRI or a company or a partnership or any entity, and if there is a transaction vis-a-vis a resident, one need to be careful that FEMA there could be FEMA implications, there could not be any FEMA implications, but one should be always on a watch or on a guard when you are dealing with a non-resident. So if I take you through the content of my presentation, we'll start with the applicability of FEMA, the residential status, current account transactions, capital account transactions, and current versus capital account transactions. Then we will also look at some of the finer aspects of the liberalized remittance scheme, but only from the point of view of the individuals, and maybe or maybe current account remittances, and the investment part out of LRS may be dealt with when a person is dealing with the ODI scheme. So these are some of the important concepts that we are going to learn under the FEMA. Now, Coming to the first applicability of FEMA. So FEMA says that it is applicable to anyone who is in India at that point in time, or any person who is resident of India. So when we go abroad, we carry an invisible baggage called FEMA. It was much stringent under FERA, but under FEMA, it is still there. For example, if I go to Las Vegas and I won some prize or some money in casino, as a resident of India, I'm duty bound to remit that money back to India. Or if I go abroad and if I get some gift, or if I give some lecture and I get some remuneration, then again I need to bring back that money back to India. So these are the applicability. Now, if any foreigner is there, he is on Indian soil, and if he wants to enter into any transactions, FEMA is applicable. So it is applicable whole of India and also to persons who are resident of India. Earlier, the offices and the branch and agencies owned by a resident but situated outside India were not covered under FEMA. But now, all those kind of entities or branches who are owned by residents are covered under FEMA. And many times we have seen the violations in terms of a foreign branch of an Indian resident giving a loan to another company to set up another company, subsidiary over there. Now, these kind of transactions are not allowed. So branch profits cannot be used for further investment without Reserve Bank of India's compliances. So if we look at what are the sources of studying FEMA or interpretation, first is a Foreign Exchange Management Act 1999, then Foreign Exchange Management Rules, which are framed by the Government of India. Then there are notifications which are issued by Reserve Bank of India, then master directions which are issued by the Reserve Bank of India, and a host of topics. RBI has come out with the FAQs, and FAQs give the real intention and purpose of a particular provision. Now let me take you to some background of FEMA. In fact, the genesis of FEMA is in the FERA. FERA was a act which was enacted in 1973. Prior to that, we had the FERA 1947 Act, and then it was repealed in 73, and the FERA was enacted. That was called Foreign Exchange Regulation Act. Okay, and now we have a Foreign Exchange Management Act. So, if you look at the objective of the two acts, okay, earlier the objective was to regulate the foreign exchange, and now the objective is to manage the foreign exchange. Those who are senior would know that in the 70s there was an oil shock, okay, and during that oil shock, the crude prices went up suddenly, all of a sudden, okay, and it was difficult to manage the foreign exchange. Now, in order to conserve whatever little foreign exchange we had, what India did, India closed its foreign offices so that the foreign exchange can be saved. Now, Japan did exactly the opposite. Japan opened more offices abroad so that it can market Japan and earn foreign exchange. Now, remember, we got independence in 1947. Japan regained its independence in 1956 under the San Francisco Treaty, because after the Second World War, Japan was under the US occupation, and therefore Japan was not independent, but they regained their independence in 1956. And look at the progress of these two countries. In 1991, when India liberalized, and even today, we can't say ourselves a developed country, whereas Japan is a much developed country. The reason was this: basically India had an inward-looking economy, whereas Japan is an outward-looking economy. We started it, but we started much later. And of course, after that liberalization, which happened in 1991, which was a forced liberalization because India had only 15 days of reserves to meet its foreign exchange imports. And that was the time India, can you believe India went to IMF to get just $5 billion of loan. And look at today our reserves, more than $500 billion. Now, that's the impact of the liberalization. I still remember 1991, the headlines of the newspaper, FERA dismantled. Okay, because till that time there was a license permit quota raj. Everything was, license, everything for everything you had to have permission. Under FERA, everything was prohibited except specifically permitted. That was the kind of regime we had. In fact, the then finance minister VP Singh publicly said that even offering a cup of tea to a non-resident is an offense under FERA, because that was FERA was totally under the Dhoni principle. Okay, and so everything was welcome if you receive something, some gift, but don't ask anything from, because we are a poor country. We don't have a foreign exchange. In fact, many of the non-residents were not paying or not declaring their income in India and paying taxes, because they said that we don't have a, India does not allow our assets, and we don't have foreign exchange and everything. So these were the times, and we had no, practically very little foreign exchange was there for India, in India. But one good thing is that even in that situation, when India was struggling with the foreign exchange resources, India pledged its gold but honored her international commitment. And that is one thing which we all can take pride in it. That never ever India defaulted on its external commitment. And we pledged our gold, but we honored our international commitment. So today, of course, we are on a much better footing, and that is thanks to the liberalization. That is one thing which we must always remember. In fact, I remember in 2000, I went to, there was a lecture at Mangalore, and one of the public sector bank was there. They had their NRI customer meet. They invited me to deliver one of the lectures. And the keynote speaker was NRI, and he had some difficulty in traveling those days from Mumbai airport to Bangalore. And he was criticizing India like left, right, and center. And he said that who will come to your India? There are no infrastructures. There are no good airports, this and that and everything. So I told, when my turn came, luckily I was after him. So I said that, yes, I agree with you, sir, that there are no infrastructure. There are no good roads in India, and therefore India should come, people should come and invest in India. Because that is the opportunity which India had to offer. And since they were bankers, so I said, let me tell you that you objectively evaluate any country. In fact, why I'm discussing this today, because it is all the more important in today's scenario. What are the three factors which we look at it when we go and invest in a country, or when we make any investment, is for that matter? We look at liquidity, returns, and safety, LRS, correct? What we look at? Liquidity, returns, and the safety of our investment. So I said that you look at the 130 billion plus population. Now in those days it was 120 or so. I said more than 100 billion population. Where would you get here, if you know the art of selling, you can sell from pin to plane. Okay, because nowhere in the world you have such a large population living under a democratic rule and sort of open market economy. So you have all the more liquid. In fact, now if you look at our stock markets and our finance markets are getting deeper and deeper. In those days, central government had given a 16% rate of return guaranteed on a power project, sovereign guarantee of 16%, which was unheard of in any part of the world. And that is sovereign guarantee. So I said, you look at the returns. Okay, in any case, returns were very high. And third was a safety. I said that you look at your investment, that if we didn't have a foreign exchange, then we placed our gold, but we honored our international commitment. So there is, your investment is as safe as it is in the bank locker. So even today, if we evaluate India on these three parameters, we find that yes, liquidity is there, returns are very high. In fact, that is why most of the NRIs also park their money in India, even though they have several other factors such as emotional connect, financial connect, social connect. So besides all that, even if they want to objectively evaluate, they get a very good return, and rupee is not that unstable. Rupee is more or less stable. So liquidity is there, returns are good, and even their investment is safe. Because today, when we look at the world around, we find that India is one of the safest country, in terms of political stability, in terms of the returns, in terms of the investment, and everything. So FERA did one good job. Although FERA was considered as a criminal act, and because the officers had powers to arrest without warrants, and therefore, enforcement was one agency which people were afraid about. But one good things what FERA did to India was to save India from the Southeast Asian currency crisis, where countries went bankrupt. India was protected because of the FERA. After the Southeast currency crisis, in fact, before that, India also pondered on opening up its economy on the capital account. But because of the Southeast Asian currency crisis, that decision was put off. In fact, Tarapur, a committee was set up, which submitted its reports in 1997. But because of this currency crisis, the decision was put on hold. But one good thing which was done in 1999, when the FEMA was enacted, government came out with a distinction between current and capital account transactions. In fact, in 1998, government gave assurance to WTO that any legitimate current account transactions, India will honor it. And that's what we find even in the FEMA. So any current account transactions, legitimate current account transactions, barring those few prohibited transactions like sweepstakes, lottery, proscribed magazines, etc., etc. So barring those few transactions, any legitimate business transactions, government will release foreign exchange for the current account. Yes, government has a right to restrict the investment as far as the capital account transactions are concerned. Earlier, it was complete delegation was given to the Reserve Bank of India to frame rules to regulate current capital account transactions. But now government has taken back those powers, and now government of India is regulating capital account transactions as far as the Indian industry is concerned. So we have this now Foreign Exchange Management Act, a very pragmatic act. This act has also undergone some change, and with the introduction of the Black Money Act, with the introduction of the Benami Act, to give more teeth to those acts and to give more power to the officers. Even some criminal some provisions to deal with the criminal aspects are introduced in FEMA as well, which was not part of FEMA, but now it is part of FEMA. Then there are FEMA rules. As I said, these rules are framed by the government of India, and government of India has a right to restrict any current account transactions. So in the interest of the country, if there is a need, then government can restrict or frame the rules to restrict the current account transactions as well. Of course, a sovereign state has always the right to protect the interest, and whatever is required to do in that situation, it can do that. So basically, as I said, some transactions which are prohibited, like subscription to the proscribed magazines or buying sweepstakes, the lottery, or remittance out of the lottery proceeds. These are the current account transactions which are not allowed even today. And then there are regulations for the troops which are going cultural tours or delegations, etc. So in some cases, the ministry, the respective ministry approvals are required for going abroad as well in a group, etc. Of course, for individual travels, there are no restrictions. Then we have a host of notifications. Okay, originally there were only 24 notifications, but now it's running into more than 250, 300 notifications. Now these are the notifications. There are notifications dealing with each aspect. For example, notification dealing with the bank accounts in India, or say foreign direct investments in India. Notification dealing with the properties in India or abroad. Notification dealing with the investment outside India, exports, imports. Okay, so these are the topic wise. There are different notifications which one need to go into the detail to study. And there are notification with deposits regulation. Now deposits regulation per se also deals with the NRI account, Fcnr account, etc., etc. So these are the notifications which we need to study in detail. And very important aspect of the definition of NRI, which I'm sure Pradeep Bhai is going to take you through. The definition of NRI also may change from a notification to notification. So it's something which is a notification specific, which one need to go into the detail. For example, the notification dealing with the business in proprietorship. Okay, the definition of NRI is different than the deposit regulation. There are minor changes, but then there are some differences are there. Then we have, earlier what used to happen, the Reserve Bank of India used to issue master circulars. Okay, now the validity, so what actually happens that once the notification is issued, then there are changes. Okay, and then there are changes. And it used to be, because FEMA is a dynamic law, it keeps on changing. And therefore, it was difficult to pinpoint at a particular time that what is the latest position. And in order to facilitate, public, see, basically this, Reserve Bank of India also used to issue APDR circulars besides the notification. So APDR circulars is an intention which, or it's a instruction which is given to the authorized persons. AP means authorized persons. Okay. Then those instructions, sometimes if they are only clarificatory in nature, no change in the notification. If there are some changes significant, then a notification would be issued. So when the notification is issued, when the APDR circulars are issued, it was difficult to keep track of the latest position. Therefore, what Reserve Bank of India did, they came out with the master circulars. Now, those master circulars were issued at the year end, consolidating the entire position of all the notifications or changes which are made in the past year. And that master circular had a validity of 1 year. So next year another circular would come. But then we found, or even Reserve Bank of India realized that there used to be some discrepancy in master circular. There RBI used to make some tweak or some changes in the master circular by way of master circular, which were not there in the original notification. Now what would prevail? The notification or a master circular? Then it was also realized by Reserve Bank of India that notification is a statutory power, but master circular has no statutory power. Therefore, RBI now came out with another version, and that is called master direction. And that direction is now has a statutory teeth. Okay. So master direction also deals with the same like a master circular, but now what RBI started doing, they have started amending the master direction. So one master direction with infinite validity, I would say, until the time it is replaced, the master direction is valid, but it will be amended from time to time. And the amended version you can always find on the Reserve Bank of India's website. For example, ODI, it is amended several times, and they write last amendment up to so and so date. So you can find that 2016, 17, 19, so amendments are done, and that master direction will give you the latest position on a particular subject. But if there are some differences, again, people say that master direction also cannot be binding, but the notification would be binding. It's a matter of debate because now master directions are final in that sense. The things which are left out to be clarified in master directions are clarified by the FAQs. So day-to-day issues, day-to-day problems which people have while dealing with the FEMA, Reserve Bank of India comes out with the FAQs. These FAQs are really good, and these are also available on the RBI website. And that those FAQs clarify what are the intentions, what is the position what RBI would take, and many authorized dealers, I would say all the authorized dealers, are supposed to be guided by the FAQs. Again, it's not necessary that FAQ gives the correct, or I would say the final authority, because one can challenge the FAQ and go to the notification and interpret the law as it is. So when we go to Reserve Bank of India for any clarification, they always say that these are the notifications, or you just read, you take a call, and do the interpretation and take a call. But just as in a tax practice, when CBDT issues a circular, though it is not binding on us, we get guided by it, because that shows the intention of the legislature, and of course it is binding on the officers concerned. So here also FAQs gives the intention of the Reserve Bank of India. Now it is up to us, to what extent we would get guided by it. In practice, I have seen that nobody generally goes against the FAQs, because again that is also an intention which is pronounced by the regulator. So coming to the chapters, chapter 1, section 1 and 2 preliminary. Section 2 deals with the important definitions. Then we have a chapter, section 2 deals with the important definition. And then section 3 also, regulation and management of foreign exchange. Chapter 3, authorized persons. We have chapter 4, contravention and penalties, from section 13 and 15. Sections 13 to 15. Chapter 5, adjudication and appeal, section 16 to 35. Chapter 6, Directorate of Enforcement, chapter 36 to 38. And lastly, we have chapter 7, miscellaneous, 39 to 49. So as I said, there are only 49 sections, but having a far-reaching impact. So when we look at the preamble of FEMA, we find an act to consolidate and amend the law relating to foreign exchange with the objective of facilitating external trade and payment, and for promoting the orderly development and maintenance of foreign exchange market. So this is the objective. So consolidate and amend the law related to foreign exchange. So objective is to facilitate external trade and payment. The objective is not to hinder the foreign trade, okay, and promote the development of foreign exchange market in India. So as I said earlier, it extends to whole of India and also extraterritorial jurisdiction. So all branches, offices and agencies outside India owned or controlled by a person resident in India, and any contravention committed outside India by any person to whom this act applies. So as I said, if I go abroad, if I earn something, I need to bring back that money back to India if I am a resident under FEMA. Now, let us look at the definition of residential status. So, non-resident Indian means a person resident outside India who is of citizen of India. Okay, now we have another category called OCI, overseas citizen of India also. So under FEMA, the word non-resident is not defined, on NRI is not there. It says person resident in India or person resident outside India. So where does this term NRI comes from? This term comes from various regulations. So various notifications under which it is like deposit regulation, it is defined. But for our practical understanding and the studies, NRI is synonymous to non-resident. As far as the FEMA is, or our study is concerned. So let us look at now residential status. Section 2U deals with the residential status. It says person includes an individual, HUF, company or a firm, AOP or BOI, whether incorporated or not, every artificial juridical person not falling within any of the proceedings of clauses or agency, office or branch owned or controlled by such person. So when we compare this definition with the income tax, we find that local bodies are not covered here, which is there as a person. So we can say that FEMA does not apply to the local bodies and the government uh, constituents. So it includes HUF, it includes company, it includes artificial juridical person like company, of course AOP, BOI, etc., firm also, and other agency or offices or branch. Now let's look at the important definition under FEMA. So what it says, a person resident in India means a person residing in India for more than 182 days during the course of the preceding financial year, but does not include a person who has gone out of India or who stays outside India in either case for or on taking up employment outside India, for carrying on outside India a business or vocation outside India, or for any other purpose in such circumstances as would indicate his intention to stay outside India for an uncertain period. So basically three things: a person who is residing in India for more than 182 days during the course of the preceding financial year. So if we are today, 5th April, if we are deciding, then we have to look at the residence or physical presence or residing in India in the last year, that is 21-22. And if the person is more than 182 days in India, then except in case where he is going abroad for employment, business or vocation or uncertainty. So technically speaking, or interpreting this, today on 5th April, if you leave India for the purpose of employment, say in Dubai or Singapore, then you become non-resident from that day. Because though you are in India for last year, financial year, but you are leaving India for the purpose of employment, and therefore you would be non-resident. The problem is, the way the wording is that in deciding who is a resident of India, when the person returns. So the second part says that a person who has come to, now let us again read, a person residing in India for more than 182 days during the course of the preceding financial year, but does not include a person who has come to or stays in India in either case otherwise than for taking up employment in India, for carrying on business in India or a business or vocation in India, or for any other purpose in such circumstances as would indicate his intention to stay in India for uncertain period. So those three same conditions which are applicable for while going are applicable while coming. But because of the two negatives, but does not include. So a person who is there in India, okay, in the more than 182 days, who has gone out, who has come to India or stays in India, in either case otherwise then. So it means that person who comes to India for employment, business or vocation and intention to stay would become resident of India from that day. Now this is one of the interpretation, most logical one, that a person would become resident of India if he comes to India for a purpose of employment, business or vocation. Otherwise, if that person has to say fulfill the physical presence criteria of more than 182 days, then even if he has come for employment, unless he completes 182 days in the preceding financial year, he would not become resident of India. Let me give you an example. Today is the 5th April. If some NRI, say Mr. Patel, comes to India today, okay, for taking up employment. Now, if we apply the definition of physical presence or residing in India, then for the last entire financial year, he was not in India for more than 182 days. Let's assume that in the current financial year, his stay in India is more than 182 days. And if we go by this only the leave one, then what happens that he would become resident of India only from 1st April 2023. Now that would lead to an absurd situation because he would be doing a lot of transactions in India. Now, we know that any transaction done with a non-resident will have some implications. And therefore, the logical interpretation is that that person comes to India for employment, business or vocation, or uncertain period, he becomes a resident of India. Now, why I took that other view of him requiring 182 days presence? It is not out of the context because there are two places where there is a requirement for that person to complete the 182 days criteria. And that is when a person wants to buy a property in India, that person cannot just take up employment and go ahead and buy the property. Now, let me just give you a little background. Under FERA, a foreign citizens could not buy property in India. The buying of property was linked to the Indian citizenship. Under FEMA, it is linked to a person who is resident of India can buy property. Now, after the enactment of this law, it was found that many foreigners, especially foreigners regularly visiting Goa, they used to show some temporary employment or fake employment and went ahead and bought properties. And suddenly government realized that this is not the intention. And therefore they came out with there is a press release, okay, that if foreigner wants to buy a property in India, that person has to complete 182 days criteria, or anybody for that matter, to become first resident in India, and then that person can buy property. So this is in a nutshell. Now, why this confusion? Earlier under FERA, it was only three criteria. Look at the intention. So intention is employment, business or vocation, or uncertain period. Under Income Tax Act, it is a physical presence which is required, but that physical presence in the current year. Here, because it is linked to the previous financial year, there is a gadbad, there is a problem. Now, how do you determine the intention of a person? So look at the visa. On what visa a person goes. Suppose if I go on a tourist visa, even if I show an employment letter in say UAE or say in Singapore, can I claim that I have become non-resident? The answer is no, because I am going on a tourist visa. I am not supposed to work there. Officially also it's not allowed. Okay. So look at the visa on which a person is traveling. Look at the other circumstantial evidences like his bank account, whether he's staying in a hotel. Of course, staying in a hotel need not be a criteria, but suppose if that person has hired an apartment, that shows that the person has intention to stay long in that country. Business or vocation, again, look at whether he's going on for the business purpose. Travel is different than doing business in that country. So if I just go to do a business with Singapore and I come back, I may be on a business visa, but that is not what is intended. I should go and set up a company in Singapore, and then if I'm doing an entrepreneurship mode for employment, then I can claim to be a non-resident. Now, uncertain period. How do you establish uncertain period? So again, there are no fixed criteria, but 6 months is generally considered as uncertain period. Suppose if I go on an immigration visa, so that shows that my intention to stay is indefinitely. Okay. A spouse gets say H-1B visa and the other spouse follow, or that other spouse has no certainty or when that person would come back or anything. So that is uncertain period. A person comes to Bollywood just for exploring career or goes to Hollywood for exploring careers. So that is an uncertain period. So one has to look at the facts and circumstances of each and every case, and one cannot generalize that what is uncertain period or what is a certain period. So as far as the FERA residential status is concerned, it's a fact specific. One need to go into the details. Now, who decides the residential status? It is you who will decide the residential status. It is you and I. We have a right to decide our residential status. Then how do I get an NRI status? Will I get a certificate from government? No. The conclusive evidence of getting an NRI status is from the bank. So the moment the bank is supposed to scrutinize all these documents, okay. So I may file a declaration, and the bank today is, they said, okay, it is your funeral. You take a call. You give us a declaration, and we'll change the status. But an alert banker would always ask for the evidences. And bank, the moment my residential bank account is redesignated as NRI account, that is the time I would officially get an NRI status, that I have become a non-resident. So very, very important. I always emphasize when I address to bankers, I said, you have immense power. Okay, please use that power judiciously. Okay, very, very important. So person resident in India means any person or body corporate registered or incorporated in India. Then so earlier definition was for individuals, now for the other entities. So for any person or body corporate registered in or incorporated in India becomes a resident. Any office or branch or agency in India owned or controlled by a person resident outside India. So when a foreign company has a branch in India, that branch becomes a resident. Similarly, in Indian as a foreign branch, that branch would be considered a resident in India. Under FERA regime, the fourth category, an office, branch or agency outside India owned or controlled by person resident in India were not considered as a resident. They were considered as a non-resident. But there is the policy shift here, and we find that this category is now part of the residential status. It has its own repercussions, that if the foreign branch, as I gave an example earlier, wants he gives a gift to somebody, okay, or sets up some does a further investment, that is not allowed. Then the definition of person resident outside India, that is a non-resident. So person resident outside India means person who is not a resident in India. So one has to look at the definition of residential status in order to determine whether he is a resident or not. That takes us to the another important aspect of OCI, that is overseas citizen of India. It means a person who is resident outside India and who is registered as an overseas citizen of India card holder under Section 7A of the Citizenship Act 1955. So we do advise our clients, NRIs, that you obtain this card, get registered if you are a foreign citizen, because there are a host of benefits, like they can travel freely to India, no need of a visa, and as an OCI, it's a different category or a status in itself. So differences between Income Tax Act and FEMA, as I said, under Income Tax Act, also there is a mention of 182 days physical presence, but Income Tax Act requires stay of 182 days in India, while FEMA requires a stay of more than 182 days. So there is a difference of 1 day, and that 1 day sometimes makes a lot of difference. Okay. So in FEMA it is 183 days or more. Income tax 182 days or more. Income Tax Act considers the current financial year, whereas FEMA considers the immediately preceding financial year. Income Tax Act does not consider the reason of stay in India or visit abroad for determination of residential status. FEMA does. Income Tax Act merely considers number of days stay in India. So if a person is in India for even as a hospital treatment, then that person, or say person is even in jail, that person would be number of days to be counted. FEMA, it is not like that. In fact, there was a case where the passport of the Indian person was impounded, and therefore that person could not go abroad. and the court held that those number of days can be excluded from determining the residential status under FEMA. It was a FERA case. So under FERA, intention, because that person's intention was always to go out. Okay. Now, under the pandemic, many people could not fly abroad because of the travel restrictions or suspension of international flights. And Reserve Bank of India has been taking a lenient view that those who are forced to stay in India can continue their NRI status despite their physical presence increasing 182 days, because their intention is always to go back. So when it comes to Income Tax Act, you are either resident or non-resident for the entire financial year. That is, you cannot be considered resident for the part of the year and non-resident for the rest of the year. So split residency is not allowed under Income Tax Act, but under FEMA it is possible. Now let me give you an example. I am a resident of India. It's the 30th June. Okay, I go abroad for taking up employment on 1st July. So till the time of 30th June, I might have used my LRS limit of $250,000 for remittances abroad as a resident. Once I become a non-resident from 1st of July, I may use the NRO limit of $1 million. Possible in the same financial year, which is under Income Tax Act, either you are resident or you are non-resident. It cannot be splitted into two parts. Now, let's look at some of the important definitions. Some definitions are there. Repatriation outside India. It means buying or drawing of foreign exchange from an authorized dealer in India and remitting it outside India through banking channel, or crediting it to an account denominated in foreign currency or to an account in Indian currency maintained with an authorized dealer from which it can be converted into foreign currency. Very, very important definitions in the context of today's context. Why? The entire FEMA, if you look at it, especially FDIs, whether you have repatriable investment or non-repatriable investment. So what is repatriation? Repatriation means you can take your money back, but you can't take your money back, through a hawala or through a cash. It has to be through a normal banking channel. Now, why I brought up this topic? It talks about through banking channels or crediting to an account denominated in foreign currency or to an account in Indian currency maintained with authorized dealer, because both are allowed in India. Now, these days, there are fintech companies which facilitates you to open an account. It's a virtual account, okay, where there is no bank. It's a virtual account. And people are opening such account and dealing in the cryptocurrencies. Now, can you say that this is, repatriation or transfer of money through a normal banking channel? I have my sincere doubts. So these are the, this could be held as a contraventions in days to come. Other important definitions are currency, export, overseas corporate bodies, okay, and NRI. So currency, now, currency includes, basically, if you look at the definition of currency includes even the plastic money. So any form of, means of exchange is covered. Whether the cryptocurrency is a part of it, it's a question mark. Okay. Then export, the definition of export. The definition of exports includes those services. Okay. We'll see this. Let's see this definition in little detail. So currency definition, if you look at it, what it says, currency includes all currency notes, postal orders, money orders, checks, draft, traveler's checks, letters of credit, bills of exchange, promissory note, credit card, and such other similar instruments as may be notified by Reserve Bank. And therefore, whether the crypto is a currency or crypto is an asset. So I don't think so. Reserve Bank of India, I have no knowledge that whether, in fact, RBI is against the cryptocurrency, and therefore the investments in crypto So there is an opinion that investing in crypto is not governed by FEMA at all, because it is neither currency nor an investment. So these are the views which are taken by the aggressive views, I would say. Export with its grammatical variations and concrete expression means taking out of India to a place of outside India any goods or provisions of services from India to any person outside India. Now, why included this definition is important? Because suppose today, I as a chartered accountant raise an invoice on my say US client, then I am duty bound to realize that foreign exchange within 9 months. That is a time limit for realization or exports. Earlier, it was not part of services, was not part of the export definition under FEMA regime. But now I have to adhere to the FEMA regulations. Problem what I would say issue is that when I export goods, I file export declaration form PDF, and it is monitored by the banks. But when I render a services of export of services, there is no declaration which is required to be filed, except that LUTI filed for the GST purpose. But otherwise, there is no monitoring. Therefore, it casts a responsibility on the exporter of services to realize the foreign exchange within the time limit. Okay. How it can be monitored? It will be monitored on the date of receipt. So suppose I made an invoice today and I receive it after 2 years. Of course, bank is going to ask me, show me the purpose, why you, for what account you have received it. And the moment if I submit a 2 years old bill invoice, I'll be in trouble. So this is a one thing which one need to keep in mind as an auditor. If there are export of services, you must look at the timeline within which the realizations are made. Just as we check the export realization for goods, export realization for services are also important. Next, definition of current account. Now, as I said, FEMA did one good thing, is to bifurcate all transactions into current and capital account. That facilitated government to open up its economy, India's economy, in a phased manner. And today we find that India is open on capital account to up to 250,000 US dollars. That is 250,000 US dollars. So one can say that to that extent we are, convertible on capital account as well. So definition of current account, it says means a transaction other than a capital account without prejudice to the generality of the following. Such transactions includes. So normal foreign trade, banking payments due in connection with the foreign trade, other current business services, other short-term banking loans and credit facilities in the ordinary course of business. Now, what is short-term banking and credit facilities? Nowhere defined, but practically it is 1 year, less than 1 year. It is considered as a short-term. Next is a payment due as interest on loans and as net income from investments. Then remittances for living expenses of the parents, spouse, and children residing abroad. Expenses in connection with the foreign travel, education, medical care of parents, spouse, and children. These are the items which are included in the. Of course, when it says that expenses in connection with foreign travel, medical, or living expense, it includes self also and others also. Now, capital account transactions. Capital account transaction means a transaction which alters the assets or liabilities, including contingent liabilities, outside India of a person resident in India, or assets or liabilities in India of a person resident outside India. So basically, it's an alteration of assets and liabilities. Okay. So if there are any transactions on capital account, then it should be in the nature of altering assets or liabilities, including contingent liabilities. So let us look at the distinction between the two, current account and capital account transactions. Now for the timing, we need to put our accountant's mind aside, and it's not exactly current account means revenue and capital account means capital account, revenue and capital. So that distinction need not be kept in mind right now, because here what we understand as a capital can be a current account as well. So you look at the foreign trade book, or the balance of payment situation from India's perspective. So illustration of list of current account. So if I import a machinery on COD basis, I may capitalize it, yet it is a current account transaction because I have imported machinery, I paid on COD basis. It's a current account transaction. We have seen that payments in respect of the foreign trade transactions. But if the same machinery, if I import and I raise an overseas loan, okay, say supplier's credit or buyer's credit. Now buyer's credit and supplier's credit also considered as a current account up to the limit of 3 years. But any arrangement beyond 3 years is considered as external commercial borrowing, and that falls into the capital account transactions. So import or export of goods on credit is a current account transactions. Payment for web hosting, current account transactions. Payment for consultancy, current account transactions. Remittance on account of interest on loan, investment, dividend, rental from your property. These are all current account transactions. Now, why this distinction is important? Because there could be a situation where the investment per se is a non-repatriable, but this, income thereon would be considered as a current account and therefore repatriable. And mind you, this repatriation of current income is without any limit. So that is the advantage. Short-term working capital loan from a bank, again current account transactions. List of the capital account transactions, term loan from bank and financial institutions, investments in securities, whether in India by non-resident or outside India by resident, investments in immovable property, whether in India by non-resident or outside India by resident. These are the capital account transactions. Now, I will just briefly touch upon these bank accounts, NRI account, NRO account, and FCNR account. NRI accounts are maintained in Indian rupees. The principal and interest amount are credited on it are fully repatriable. That is, you can take the money out of India anytime. And therefore, any withdrawal out of NRI account is considered as repatriation to India. Okay. So any repatriable account, investments would be qualified from NRI account. So NRI account, any investment is qualified as a repatriable investment. Interest earned on this account is also tax-free. Then NRI account may be maintained in any form: savings, current, recurring, fixed deposits, etc. So it is as good as our savings account, but with a repatriable facility. Joint account can be opened by 2 or more NRIs and PIOs, or by NRIs with resident relatives on forbear or survivor basis. Or during the lifetime of the NRO PIO account holder, the resident relative can operate the account only as a power of attorney. So wherever there is a resident power of attorney, that person can operate, even if a joint holder, can operate only as a power of attorney. Another important thing, withdrawals can be made out of NRI account, but gift cannot be made except by the account holder himself. So resident power of attorney holder can operate the account for day-to-day expenses, but not for making gift. So that is one thing which one needs to bear in mind. NRO account, this account type is generally used by NRIs to save their Indian income. Rent income, dividends from investment, pension fund can be paid to these accounts. The interest earned on this NRI is taxed at the rate of 30% subject to. Now, this is one thing where you can do a lot of savings for your clients. A lot of NRIs are not even aware that their the interest earned on NRO account can be saved. The tax thereon can be saved substantially by applying the tax treaty provisions. So if that person is eligible for a particular tax treaty, then normally the interest is taxed at the rate of 10%. Okay, whereas it is taxed at a higher rate under the NRO account directly, under the Income Tax Act. So one need to obtain the TRC, just guide them. In fact, the amount of tax they save would be much more than the fees they pay. You can double your fees. Okay, so that would be a direct advantage of learning this international tax and FEMA. So please recheck your NRI clients, and you can do some savings for them. It's a legitimate saving. The accounts may be maintained in any form, savings, current. So normally our ordinary account, resident account, would be converted into NRI account, but NRI account can be also opened afresh. NRI can open an NRI account. The rate of interest is much more compared to NRI account, which is pegged to LIBOR plus. But here the rate of interest is quite high. The accounts may be held in jointly with resident on former or survivor basis. NRIs and POIs jointly can also hold, NRI account. FCNR is a foreign currency. As the name suggests, there is no loss of exchange on conversion. When you park your money into NRI or NRE, you lose both the times, when you convert into Indian rupees and when you convert back into the foreign currency. NRI account, you can now, NRIs can withdraw up to or repatriate up to $1 million every year. So that is a benefit under the NRI account scheme. NRE and FCNR, without limit, it can be repatriated, because these are the accounts which are generated out of the foreign exchange earning only. So NRIs can remit the money and open either FCNR or NRE account, or NRI account, of course. So NRIs and PIOs both are permitted to open and maintain. Now, instead of PIOs, one can say OCIs are permitted to open and maintain these accounts. Deposits may be accepted in any permissible foreign currency. Foreign currencies are stored in this account. It helps to avoid foreign exchange fluctuation, as I said. It can be maintained only in the form of fixed deposit. So that is a limitation of FCNR deposits, but it is fully repatriable whenever the person wants it back. Now, change of residential status, Pradeep can take in detail as an obligation, but just to pass a reference, as I said, the first official recognition as a non-resident is your change of bank account status from resident to non-resident, even your demat also. So you need to intimate your bank account, banker, need to intimate your demat custodian, continuation as a partner or proprietor, no problem, unless even now RBI has clarified that even if those activities like say agriculture, etc. are there, that can be continued, but no fresh investment can be made. You can continue as a partner or proprietor, but ideally it is advisable that you change the structure, because clients are not that disciplined to make further investment, not to make further investment. So it is better that if they resign and otherwise make somebody else as a partner or a proprietor. One can continue as a director or a trustee trust. Loans given in India. So loans can be continued only with the same terms and conditions which were given at the time of issuance of the loan. It cannot be renewed further. But if somebody wants to give a fresh loan, then there are different regulations for giving a fresh loan. This is a resident to one becomes a resident to non-resident. Loans obtained in India can be continued. It can be repaid either from Indian sources or even from earning from foreign. It is advisable that power of attorney is executed in favor of a close relative, so that day-to-day transactions or operations can be carried out easily. Now, there is no time limit prescribed under the Act for intimation or obtaining permission, but usually it is 30 days is considered as an ideal time. There have been penalties which are levied for contravention or late intimation, so one need to be very careful to intimate the bankers and the regulatory authorities wherever it is required. Same way, there are some obligations on becoming non-resident to resident returning Indians. So assets abroad are covered by Section 6(4) of returning Indians. They can continue their business abroad. No need to close down the business. They can continue their movable assets abroad. no need to bring those assets back in India. Earlier, there were refugee schemes, and they were given some window, but now all that is gone. They can do whatever they like with their foreign assets. Bank accounts in India, yes, it has to be redesignated as a resident account, and that is very crucial. In fact, in case of NRI, it is said that the NRI account would be considered as a resident account from the day person becomes resident in India, but fixed deposit can continue up to maturity, and therefore there are a lot of misunderstanding that if I continue a fixed deposit, then my interest continues to be exempt. So there is a gray area there, because when we look at the definition, the exemption under section 10(4), it says that non-resident is per FEMA. Now I have ceased to be a non-resident. I still continue NRI account, and people are claiming it. Sometimes they are put in difficulties as well. Investments abroad can continue. They can continue the investment abroad. No need of liquidation. They can deal with that investment. They can reinvest after selling also. Again, time limit for intimation. No time limit fixed time. 30 days is generally considered as a suitable. Possession, retention, and surrender of foreign exchange. The various time limits are there. So I'll just quickly run through for the sake of completion. Otherwise, you can go through the PPT. It is there, all the time limit. So specific receipt in foreign exchange within 180 days of its receipt for individuals and 7 days for others. Like remuneration, I gave an example that when I go abroad, if I earn something, I need to surrender it. Any settlement of any lawful obligation, inheritance, settlement or gift, income on assets held outside India, when I become a resident. But if this income is earned from assets which I acquired while I was a non-resident, then I can reinvest it. I need not bring it back. So residual categories, within 90 days, unspent foreign exchange acquired within 180 days from the date of its acquisition or purchase for individuals and 60 days for others. Unspent foreign exchange, other than travel 180 days, unspent foreign exchange for travel, it is 90 days from the date of return, but I can keep my traveler's checks up to 180 days, and I can keep my currency up to 2000 USD. Okay, so that is without any limit. Authorized dealers, they can keep possession, retention of foreign exchange up to the limit within the scope of their authorities. Any person resident in India, I can keep any number of foreign coins for numismatic purpose. There is no limit. Okay, but foreign currency notes up to and including travelers check, everything up to $2000 or its equivalent. For a person who is resident but not permanently resident in India, now these are category of which is carved out. It refers to those expatriates who come to India for employment for a specified duration. So say there is a foreign technocrat who comes to India for 6 months or say 3 years duration. So he's stationed in India for 3 years. So he becomes a resident, but he is not a permanently resident because he comes on a fixed duration. So those kind of persons can keep foreign currency notes without any limit, provided this was acquired or held or owned by him while he was non-resident, legitimately brought into India. Liberalized remittance scheme, it is allowed up to $250,000 per financial year per individual. What kind of current account transactions are permitted without RBI permission? So remittance by artist, wrestler, dancer, as I said, in some cases you require permission. So here the permission of the Ministry of Human Resource Development is required. Travel abroad, gifts, donation, employment abroad, immigration, all are covered under this 250,000 USD. Maintenance of close relative. Okay. Again, up to LRS limit. Business travel, attending international conference. So all this, would be covered under this limit. Business visit as an employee of the Indian entity where expenses are borne by the entity without any limit. Medical treatment abroad, hire of 250,000 USD or the estimate which is given by the doctors in India or hospital abroad. This includes an attendant to a patient going abroad for medical treatment or checkup. Person on foreign to requiring medical treatment, same above. Studies, again, higher of the estimate from the institution abroad or US dollar 250,000. Commission to agents abroad, higher of the 5% of inward remittance or US dollar 25,000 for sale of residential plots or commercial plots in India. Short-term credit to overseas offices of Indian companies, any amount. Remittance for advertisement on foreign television, any amount, because it's a current account transaction. Architectural consultancy services procured from abroad up to US dollar 1 million. Even though it is a current account transaction, there is a limit here. And that limit is up to US dollar 1 million. Use and purchase of trademarks and franchise in India, any amount. So, friends, we come to the end of our presentation, but some one or two case studies and some tips for practicing. So FEMA is a dynamic law. Don't give any off-the-cuff answer. Whenever you confront a situation, take your time to do the research, to find out the current positions, discuss with your colleagues, friends, and don't be ashamed of that. Okay, and nobody knows the entire scenario. So it is always better to discuss with your professional colleagues in case of doubt. Take the expert advice, in case of a problem, because as I said in the beginning, remedial would be difficulty, but better to correct the course when it is happening. Amendments are on. So as I said, it's a very dynamic law, and today we are living in a very fluid situation. And just if I can share with you, yesterday only there was a case where one youngster wanted to invest in cryptocurrency through these fintech companies, and he made his parents to gift him in his foreign currency account under LRS. Now, this is something which is clearly not allowed. So, but these youngsters, and first of all, cryptocurrency itself, whether it is legitimate or not legitimate, is not yet clear in India. And then to a resident, one resident cannot give to another resident in foreign currency in its foreign account, unless that person is a joint bank holder. So these are the kind of contraventions which are happening knowingly, unknowingly. One needs to be very careful. And the amendments which are coming, ODI, for example, is likely to come up with a new regime, because they had already issued a circular or draft regulations for the discussion and debate and feedback. FDI, we have seen recently amendment done to accommodate the public issue by LIC. So there are various reasons for the amendment, and which will keep on coming. One needs to keep abreast. The best thing is to be a part of the study circle where live issues are discussed. Attend FEMA courses like this, where you can get updated on your knowledge, and that is how you can keep the track of what are the latest developments. One case study which I have taken up, I will just take it up before I wind up. There is a condition that a person should be in India in the preceding financial year for more than 182 days for being a FEMA resident. These conditions becomes irrelevant when a person leaves the country for employment, etc. But in a reverse case, it is not clear when the person who has gone outside India for many years and returns to India for good. So whether that person becomes resident only in the next financial year, I have already given you example, once he completes 182 days, or in the previous financial year of his coming back. This is relevant because that person to become partner in LLP in India, whether he has to wait for 1 full year to become resident, whether he will be able to undertake any transaction as a resident Indian, either on current account or capital account. Under LLP Act, it is required that partner has to be a resident of India. Okay, now that is why this one of the partners should be resident of India. Also, for the exemption of NRI bank interest under Income Tax Act, condition is that the person should be non-resident under FEMA. So can one claim this exemption in the year of return on the ground that he still not become resident till he completes 182 days of presence in India? The pointers are definition of the residential status, 2V, problem of language and difficulty in interpretation. We have already seen the definition, the intention of a person, the two negatives, okay, and therefore there is a difficulty in the interpretation. Then, even under the FAQs, there is a press release, there are conflicting things. So we'll go by the logical interpretation. As far as the LLP is concerned, it says that every limited liability partnership shall have at least two designated partners who are individuals, and at least one of them shall be a resident in India. And luckily, it is clarified that for the purpose of this section, the term resident in India means a person who has stayed in India for a period not less than 182 days during the immediately preceding 1 year. So for one to become partner in LLP, one need to wait for, if today somebody is returning without being 182 days or more present in India last year, that person will have to wait for 1 year. Okay. So very clear. As far as the property is concerned, I have already told you there is a press release which is issued by a Minister of Finance, which also imposes a condition of physical stay in India for more than 182 days during the preceding financial year. So at least for these two purposes, there is no ambiguity. One has to complete 182 days stay in India, and then only that person can become resident of India in order to be a partner in the LLP or in order for that person to buy a property in India. So these are the two very clear. As far as the NRI account is concerned, one can still there also claim that, see, I have not become a resident because I'm yet to complete my 182 days criteria, and therefore I am eligible for NRI account interest exemption. So NRI account should be, but only thing is that the para 7 of the schedule 1 of the FEMA notification says that NRI account should be redesignated as a resident account, okay, and or the funds held in this account may be transferred to RFC account immediately upon the return of the account holder for taking up employment or carrying on business or vocation in India or for any other purpose indicating intention to stay in India for uncertain period. Now this is one of the requirement under the NRI account, but this talks about the redesignated as a resident account, and therefore can one say that no, your account will continue because I am allowed to continue my fixed deposit till the maturity. And I have seen practically banks are not insisting on conversion; they are allowing clients to earn tax-free interest till the time of its maturity. So these are my few thoughts of the subject. Again, I thank you very much for your patient listening. And if there are any questions, we can take up.
Yes, sir. So we have another 1 or 2 minutes, 2 to 3 minutes left. So do you want to take up the question, or else we'll forward the questions to you, sir, and if time permits, we can respond it.
Sure. I'm okay either way, not an issue.
So we need to start the next session. Suppose 1 or 2 minutes time. Ma'am, recommend over to you for the vote of thanks.
Sure.
Ma'am, you're muted. Sorry. Ma'am, you need to unmute yourself. 1 minute. Now. No. You're not audible. Sorry.
Okay, sir. So shall we continue with the next session, or we'll wait for a few questions?
Pradeep, sir.
We can take questions if anyone was. Or I'm ready with the presentation, not an issue. As you decide.
Okay, I just shared my screen, sir. You just see if there is any important question. Some of these you can take up. Is my screen visible? Sir?
Yes, your screen is visible.
Yes, sir. You can take up question. We'll go for 5 minutes maximum time session.
1 minute. Would there be any impact of change of residential status as ITF to FEMA? No, this definition will not have any impact on the FEMA. Okay, I'll now enlarge the screen. So this change of definition will not have no impact on the FEMA definition. If we receive consideration in the form of crypto for issue of shares to NRIs, how can we deal with such a transaction? It is not allowed because crypto is not an official banking channel. So this particular transaction would be a contravention of FEMA, and you can be, subjected to penalty and compounding. A person who leaves India on 1st January 22 to overseas for carrying business as per the exclusion of 25, will he be treated as non-resident for 21-22? 1st January, so he will be non-resident from 1st January 22. So part of the year, yes, only for 3 months, not for the entire year. Realization of money against export services goods should be within 9 months. What if the funds did not hit within this time? A good question. One need to seek an extension of time from the authorized dealer. Usually they give for 6 months. But even if within that extended time period it is not realized, then you should take all the necessary steps for realization, like writing to the diplomatic missions over there, or especially we should have robust communication. You should make all the efforts to realize. If you don't make those efforts, then you will be held there, person in default, and you will be subjected to contravention and compounding. So see that today people say, no, I did phone calls. Phone call is not record. So send an email, but save those, or registered AD is a better idea. In many cases, if there is a dispute, you can even hire a lawyer or take an estimate from the lawyer. And if the export amount is within the the 10% of the average turnover, then you can go for the self write-off as well. A person born in India went to UK and opted for British citizenship. His children are also given British citizenship. When the family returns to India permanently but continues to hold British citizenship, what is the status of each of the person of the family? What are the restrictions from them in India for buying more property, taking up jobs, etc.? If they become resident of India, no restrictions, no implications. I have a client who is a British citizen and living in India for 40 years. Okay, so there are practically no implications as long as the person is a resident of India. What are the procedures about writing off receivable against for an export of service? Recent client knows that. So the write-off procedures or provisions which are applicable to goods will be applicable to services as well. I'm sure person dealing with exports will take into much detail. For the want of time, I will not go into the details. Nowadays, payment for exports received through PayPal settlement, any specific? Yes. Yeah, as I said, these are not the normal banking channel. So I would not advise anyone to receive payments like this. Export payments or import payments, be careful. Do it only through authorized banking, normal banking channel. Some, buying or selling on a personal account could be okay, but not for doing business. Whether ECB obtained from a collaborator initially for a period of 3 years can be extended for a period. Yes, ECB, though there are detailed guidelines, not only 3 years, there are, purposes for which we don't need, you need to have average maturity period of more than 3 years, 5 years as well, 7 years as well. So one need to look at the purpose for which you have obtained the ECB. And if you extend it, yes, RBI would love it. In fact, it is only problem is you want to repay ECB faster. What are the checks IT departments has to ensure that permanently returned NRI changed his status? Is there any link of PAN with immigration? Get your views. So far, I don't think so. There is any link. Permanent. First of all, how do you determine the person is returned permanently? So there is one way of determining is that whether that person has obtained a benefit under the visa. So a person who comes to India under the baggage rules, they get certain concession on the custom duty. Like they can bring the used car, they can bring certain amount of personal effects, etc. with the concession duty. So if that person has used those provisions or benefits, then one can say that that person has come for a permanent settlement in India. Otherwise, it is difficult. Normally, NRIs come and they test the waters and then they say, okay, now I decide to stay here permanently. So these are some of my views on the questions. I once again thank you very much for giving me this opportunity. Thank you.
Thank you, sir. It was a wonderful session. I'm sure, I think all of us, all the members who have attended the session got an awareness about, especially about the key points that we get queries from the client regard to residential status, especially the accounts, NRO, NRA accounts. I think this is one area where almost I think all the members would have got some queries during their course of practice. Thank you so much, sir, and especially for taking up the case study. And I'm sure even though we had a scarcity of time, you were able to address all the queries that was put forward by the members. Thanks again, sir. Now over to the next session by Pradeep Ji Tulsian, sir, with regard to the facilities and the obligations for NRI. Over to you, sir.
Pradeep bhai, thank you very much and sorry for taking your 5 minutes.
No, sure. Not an issue, sir. It's here. Thanks a lot for you.
Thank you.
Yeah. See, my topic is facilitation and obligations. Mr. Mayur has made my job very easy by explaining the few things in a very detailed manner. First of all, I take opportunity to thank SIRC for giving me an opportunity to share my views and things on the topic, that is facilities and obligations for NRIs under FEMA. First of all, we just as Mayur sir has said and do certain things. Let's go with the definitions. So far as the income tax is concerned, he has explained, so I'm not taking up. Just brief with the 182 days, that is a prime condition to become a resident. Others are resident and non-ordinary and ordinary resident. Residential status, so far as the FEMA is concerned, he has taken up that if you are taking for an employment outside India for business and for any other purpose where the uncertainty is there, then it is dependent that you are non-resident. So far as the student is concerned, the limit of 182 days in the preceding years is not applicable, and they will become the person NRI if they are going for the study abroad. This other, that is basic definition, is a person should reside outside India who is a citizen of India, and the individual resident outside India who is not a citizen of the India in all the regulations. So that he has explained. Then person of Indian origin, again he has explained it that whoever is a citizen of the India under the Citizens Act, then under the territory becomes part of India after 15th August 1947. That also covered child, grandchild, that is up to the 3 generation. Any person who is of the preceding 3 generation becomes a citizen of India. That is also PI, person in Indian origin. Spouse of foreign origin of the Indian citizen can be a PIO. OCI again he has discussed, so that we are not touching up. Distinctions is a few one, doesn't make much difference for us. So in broad, that is the list. Person resident in India means Indian citizen, and the foreign citizen resident in India for the employment, business, or any other person. Bank accounts, he has already discussed what is a non-resident external account, foreign currency non-resident banking account, and other non-resident ordinary accounts. Limits and everything he has discussed, so I am not taking up these issues. Now this is a very important thing, that under the non-resident external account and the foreign currency non-resident banking account, what type of the credits are allowed and what type of the debits are allowed. This is so important. See, we have understand what is the NRI account, Fcnr account, and NRO account. Why this is important? That if we are doing any transaction in the bank beyond this permitted debit and credits, then it is a violation of a FEMA, and violation of FEMA attracts the penal actions. So every individual who is carrying out these transactions has to be careful that what is permitted. So what is the permitted credit? That means a receipt in the account. There should be any inward remittance from outside India through the banking channel. So if any remittance is coming in India in the NRE account or the Fcnr account, that is permitted. Second one is the personal checks of received from outside India, any traveler's checks, bank drafts deposited by the account holder in person during his temporary visit to India. Suppose if any NRI coming to India for this temporary visit for a few days on some occasions, maybe a tourist visa for the tourist purpose, for any functions in family, he can deposit the traveler checks and bank drafts in his account. Tender of foreign currency banknotes during this temporary visit. So any foreign currency if he carries, he can deposit directly into the accounts. That is also permitted. Any transfer from other NRE and FCNR account. Suppose if he is holding another account, he is having two accounts in India, he can switch the funds from one account to other account. Any interest accrued on these funds. Suppose if he is keeping a deposit in the account, bank accounts, any interest which is accrued to those deposits can be directly deposited in the FCNR and FCAR account. Current account transactions in India, if he holds having any current income in India, that can also be deposited like rent, dividend, pension, interest, as Mr. Mayur said about the capital transactions and the current account transactions. So he is not permitted for the current capital account transactions, but current account transactions which are the income in India can be directly deposited in the NRE and FCNR account. Maturity of the sale proceeds of any immovable properties, if he is having any immovable properties and if he sell in India, which is a permitted investment, immovable properties which he can hold, then also that sale proceed he can deposit directly into the NRE account. Any shares and debenture subscriptions, if he received back or if he by sale of the assets, he can deposit in this account. Similarly, any applications, earnest money, purchase considerations, all these kind of things, where the within the limits of the prescribed, he can deposit in this NRE account. Now, if one is depositing the amount into the account, naturally he has to use that fund. So there is certain permits where he can use these funds. Beyond those things, he cannot use those funds. Number one, he can use this fund for the local disbursement, for local his expenses. If he want to spend some amount in India, he can use that fund. He can withdraw and spend the amount. If he want to take outside these funds, remitted back to the foreign, he can do that. It is allowed. Transfer of NRE account of the account holder or any person is able to maintain such account, he can transfer any account, any amount to the accounts held by other persons, but within the prescribed limits. Beyond limits, he cannot do that. Investment in shares and securities, commercial papers of any Indian company, or purchase of a immovable property in India, which is permitted to that extent. All immovable properties are not permitted to purchase, but certainly the immovable properties which is allowed to be purchased by an NRI, he can use these funds for those purpose. Now, what is permitted in the non-resident ordinary account? This is the most common account which all the NRIs are keeping, because it is easy to handle it. As Mayur has said that anything can comes in India, any amount in Indian currency can be deposited through the banking channel in this account. Any amount permitted in permitted currencies during his temporary visit, he can deposit. Legitimate dues in India of the account holders transfer from another accounts. So if he is having two another accounts, he can switch over the funds to another account to another account. The most important thing is he can receive the gift in Indian rupees from his relatives and others, and loan made by resident to NRI account, or a person of Indian origin relative within the limits prescribed under the liberalized remittance scheme. So this is only the account where the gifts can be received and loan can be received. NRE account cannot have received the gift and the loans. And what is the permitted debits? All local payments in Indian currency, he can make it through the account. He can remit the funds outside India of the current income, not of the capital account. Any amount which is deposited in this account, which has a nature of the capital nature, he cannot remit back these funds outside India. He has to use those funds in India only. And naturally, this fund is to be net of the applicable taxes. Any account he can transfer to the another account. Balance another account cannot be repatriated abroad except up to the $1 million, which is permitted under the LRS scheme. Up to that 1 million only he can transfer the, we can say, capital receipts or any other receipts which is permitted. Beyond that they cannot do that and has to go with for the RBI permission. Up to $1 million he can transfer to the NRI account also, and credit cards issued and all other things he can use up to $1 million. Joint account liberalization, as Mayur sir has already discussed, who can be a joint holder with the account and how they can operate the joint holder account, how they can operate the account. It is, he has discussed, but still joint holder can use these funds only for the purpose of the local expenditures, and he cannot use these funds for the barred transactions and investment in the in those which are not permitted. So only permitted transaction to the restricted to the joint holder, they can do that. The more important thing over here is only a close relatives can be a joint holder. Close relatives are defined under the Companies Act. So that is a very limited definition under the Companies Act. Under the Companies Act, only the 8 kind of relationships are permitted or to be treated as a relative. Number 1 is a father, including your stepfather. Mother, that is also again including a stepmother. Son, son's wife. Daughter, daughter's husband. Then brother and sister. Here the more important thing is brother's husband and sister's brother's wife and sister's husband are not included in this. Father's brothers, father's sisters are not included in this. So we can say that a very limited definition and immediate blood relationship and the spouse are included under the Companies Act. So the definition of relative should be understood before we go for any kind of gift transactions as well as the joint holder. Now there is another account of which the NRI can open is, that is a special non-resident rupee account. That is the account. See, if we are having a FCNR account, FCNB, NRI account or NRO account, then the business transactions are not permitted in that account. But if the person who is want to do some business in India, NRI, he can do that. For that, he has to open a special non-resident rupee account. So any resident person who outside India, excluding Pakistan and Bangladesh. See, Pakistan and Bangladesh are always an exclusion. So if they have to open in this accounts, they have always go to the RBI for the permission. Not only for this, but all kind of transactions and all kind of accounts. If the Pakistan and Bangladesh citizens or nations has to open it, they have to go to the RBI. So those who are having a business interest, they can open the account for investment under FEMA, non-debt instruments, import of the goods and services, export of the goods and services, trade credit transactions, and business related transactions. So basically this account is for the business transactions. Then this type of the account is only a current account. It cannot be a saving account or any other kind of account, even not a deposit account. It is a repatriable account. Any amount comes in this account can be repatriated back to the foreign. Debit and credits is only related to the business. Any transaction which is not related to the business cannot be carried out through this account. Number of accounts, they can have any number of accounts according to the business by a single person. Tenure, it is a current account, so there is no limits. So maximum they can open it for the 7 years and can be extended for another 7 years with the RBI approvals. But again, after 7 years, if they can continue, they will not restrict and again go RBI and take the permission. Tenure transfer from another account is not permitted, but NRI account and FCNB accounts, they can do the transfer. From another account to the special non-resident rupee account, they cannot transfer. Taxes will be applicable as applicable to all the transactions in India. Change in the residential status, if there is a change of the account holder's residential status, it has to be informed and the status should be get changed to the normal account. Reporting should be as per the RBI guidelines. So whatever the reporting requirements they have to fulfill those things. Escrow account, definitely for the capital accounts and all others, they are allowed to open an escrow account with the persons. Basically, this is a current account, and this is related to the all kind of foreign exchange risk to be met out by the account holder. This is a very specific kind of a transactions under the escrow accounts, and then mainly it happens for the capital transactions. Permitted credit and debits are restricted to the purpose of the escrow account only. Beyond that, they cannot do any kind of transaction in this account. Now there is a few case studies about the NRI account when they are returning to India. See, Mr. ABC is an Indian citizen who went to US for the purpose of his employment on the 1st January 2005. He left his job in 2019 and returned in India permanently for setting up his business. During the period of 2005 to 2019, he was non-resident under the Act. While in USA, he had opened NRI account in India and transferred his US salary income to his Indian NRI account. During 2019 to 20, he received interest income of 1 lakh from his NRI account in India. Now, can he continue to keep his NRI account after returning to India? And what will be the taxability of the NRI interest income? See, to continue this NRI account, he is not permitted. As soon as he has to come back to India, he has to inform and convert his account to the ordinary account. So once the account is converted into an ordinary account, any income which is generated through the ordinary account is taxable in India. So whatever the interest he is earned after December 2019 to the March 20 during this financial year, that is a 1 lakh rupees is taxable in India. Another case study we are taking is the taxability of the Fcnr interest if the person is coming back to India. Facts are remain same as in earlier. Now here instead of NRI account, Mr. ABC is also having a Fcnr deposit account, and its maturity is April 2020. Can he continue with the Fcnr deposit account? Yes, he can continue. There is no restriction on that till the maturity, but he cannot renew the deposit. And so far as the interest applicability of the taxability is concerned, being that is the Fcnr account, the income earned out of this deposit is a tax-free income, so he will continue to enjoy the tax exemption from this. Then transfer of NRI account to the saving account. Mr. XYZ is an Indian citizen who went to US for the purpose of his employment on 2015. He opened NRI account in the December 2015 by remitting his funds from the US. He wishes to transfer these funds from his NRI account to his Indian saving bank account, which exists before he moved to US for making some investment in India. Whether transfer of the funds from NRI account to his Indian saving bank account is permissible under the FEMA? Yes, this transaction is permitted, but he cannot repatriate the amount back. That means from the saving account, which is an ordinary account, he cannot transfer back the funds to the NRI account. But yes, from NRI, he can shift his funds to another account. Payment to employees in NRI account. ABC Limited is an Indian company, has opened a branch in Dubai. He transfers his few employees from India to work in Dubai. The total number of days of these employees were working in Dubai is more than 300, so it is more than 182 days. So they have becomes NRI. There is a specifically condition given in this case study. ABC Limited want to pay their salary to Indian NRI account of his employees in India. So this is many times it happens that when the persons, Indian companies employs a person and sending for the foreign assignment or the placement, they deposit their salaries into the Indian NRI accounts. Is it permissible? Can any company will deposit the amount in the NRI account of the employees who are working outside India in the bank account? There is no such restriction because this is a current account transaction, current income. As we studied earlier, any current income can be deposited in the NRI account. There is no bar on that. So company can deposit it. But yes, the amount should be liable for the income tax. So that thing is to be understood. So far as the credit of income is salary is concerned, it is allowed but subject to tax. Then it becomes a income accrue arise in India. Now receipt of the dividend in NRI account, it is as good as the similar case of the earlier one. There that was a salary, which is again is a current income and a current transaction. Here instead of a salary, it is a dividend. Yes, it is permitted. They can credit the dividend in the NRI account subject to the taxability in India. Now what about the facilities of the deposits? Acceptance of deposit by a company from an NRI on repatriation basis. Yes, companies are permitted to take deposits, as Mayur sir has already explained this. Certain deposits, they can take it on a repatriation basis. Any company, including NBFC, can take the deposits. Inward remittance should come from the outside India through the banking channel. It means that the Indian account from NRO account or so, they cannot take it, but yes, they are permitted to take the deposits to NRE and FCNR account. Rate of interest should be as per the applicable rules and regulations as prescribed by the RBI within the conditions of the company's acceptance deposit rules. Any deposit given to the company, maturity period should not exceed 3 years. That is a limitation. Company cannot give any scheme beyond 3 years. And there is a cap also. The deposits received from the NRI or the PIO cannot exceed the 35% of the total owned capital, owned fund. So that is a cap. Beyond that, they cannot accept. That is a limitation on the company, not on the NRI. So if there's a different companies, NRI can give a deposit to as much as he can. But yes, company cannot accept beyond the 35% of its net worth and on fund. Manner of interest can be credited to the NRI, FCNR, any account. There is no limit, no restrictions. Repatriable, yes, it is a repatriable. Not a problem with that. And use of the funds, there is a restrictions. Companies should ensure that the funds which they are borrowing from the NRIs, they cannot relend it. So means they cannot do a financial activity except the NBFC. So if any company, manufacturing company, if it is borrowing from a NRI, they cannot give it on loan to any other person, even not to the banks. That is not permitted. For the agriculture and plantation activities, any company which is engaged in the agriculture and plantation cannot use these funds for that purpose. For real estate business, the company cannot use it. Investing in any other firm, company, that is also prohibited. They cannot use these funds for the same manner. Manner of the repayment of the deposit remitted through the banking channel, authorized dealers only, being it is a foreign currency. Crediting to the NRE accounts in India or an FCNR account. And if they want to give it in Indian rupees, yes, they can do it in the depositing the NRO account. On non-repatriation, so this transaction is allowed for the repatriation basis. Now we are discussing for the non-repatriation basis. Yes, see here for the repatriation basis, firms and the proprietorship firms, partnership and proprietorship firms are not eligible. That is a main difference. So in this kind of non-repatriation deposits, yes, proprietor concerns can have a deposit from NRI. Firms, partnership firms can also take this. What are the conditions for those things? Private arrangements or with the public deposit schemes, they can do that. Partnership firms and proprietor concern, they can also take the deposit by complying the RBI rules and regulations, where at this point there is no restrictions. What is how they can take? They can debit the NRO account and take this directly from the NRE and FCNR account. They cannot take it. So first it is to be transferred to the NRE account to NRO account, and then only these funds can be taken up. Rate of interest is as per the RBI guidelines. Maturity period is 3 years. Beyond 3 years, under this condition also they cannot take it. And use that as it is restricted earlier on the repatriation basis, same restrictions are there. And the fund is non-repatriable. So whenever we are taking in the Indian currencies, it is non-repatriable. Or if the proprietorship or the firm is taking, it is non-repatriable. This is the broad snapshot as Mayur sir is saying, and as I discussed. what kind of the bank account can be opened. If it is a bank account, it is NRI account, another account, FCNR account, special purpose account, escrow account. So far as the deposit is concerned, it can be of two kinds, repatriable and non-repatriable. Non-repatriable deposits are if it is given to the proprietorships, if it is given to the partnership firms, and definitely with the restriction to the companies. Non-repatriable, as we discussed, repatriable is only given to the companies. Now, acquisition of immovable properties. This is the one of the facilities given to NRIs. NRI can acquire the immovable property. Yes, to some extent, Mayur sir has already discussed the points, but again, on a broader way, we touch those issues. Any person can purchase the immovable property other than the agricultural land, farmhouse, and plantation. It means that any land which is related to the agriculture cannot be purchased by the NRI. It can be purchased from the NRI and the OCI, Overseas Citizen of India. Only two categories are allowed. PIO we are not discussing because it is discontinued. So as of that, there is no PIO. Gift, any immovable property, if it is given on gift by someone, yes, they can take it from the resident, NRI and OCI, who is a relative. Beyond relative, if any other person than the relative is defined under the Companies Act. I told you that only 8 categories of the relations. Beyond that, if anybody is making a gift of immovable property, that cannot be accepted by the NRI. Inheritance property, yes, if it is an inheritance property, it can be acquired from any person and the resident. He can take that property. He can also sell these properties other than the agricultural land and farms. Any property, if he is having and continuing as an immovable property, he can sell this. But he can sell this property to any person, resident, NRI or OCI. Definitely to the foreign citizen, it is not allowed. That is a bar throughout this, that no property can be sold to any person who is a foreign citizen. For that, he has to be a resident, NRI and OCI. Suppose if somebody is having agricultural land also, or farmlands and plantations, etc., before he becomes an NRI, he can continue to hold those assets. Yes, or suppose if he is acquiring in the inheritance, yes, he can continue, but he cannot sell this. If he want to sell this, he has to sell this only to the resident. Even to NRI and OCI, he cannot sell this. Gift, yes, if he is receiving any property, immovable property on a gift other than the agricultural land, farms, he can give it to the resident, NRI and OCI. What type of the payment for the acquisition of immovable properties? Payment should be happen only received in India through the banking channel by way of inward remittance from the place outside India. So the funds for the acquiring of the property should come from the foreign itself only, in the foreign currency, or by debiting the NRI account, FCNR account and NRI account which he maintained in India. But if it is coming in the foreign remittance, it can come. So all the 4 ways within the India or outside India is permitted. If he is selling the properties, he can repatriate the funds, but again there is a conditions that beyond those points he cannot repatriate. Being it is a capital transactions, he is only permitted up to the USD of $1 million. Beyond that, he cannot take it, or he can take to the amount which he has brought to purchase the property. It means that if suppose I have acquired a property and from the foreign, if I transferred $1 million or $2 million to acquire the property, now when I'm selling this property for the $3 million, I am eligible to transfer or repatriate only up to the amount, purchase amount. That is, suppose if I purchase for the 2 million, I can repatriate only 2 millions. I cannot repatriate the 3 millions. So profit on sale of the immovable property should have to be retained in India. He cannot repatriate the whole amount to the foreign. So that is the restrictions. Now, what is in a broad way one has to consider when he is dealing with the immovable properties? He can acquire the properties for himself and hold immovable properties. Inherited agricultural land and plantations or farmhouse he can hold, but he cannot purchase the new after becoming an NRI. He can sell any property and repatriate the sale proceeds abroad up to the limits, prescribed limits. Can give any property on rent. Whatever the property is having in India, he can let out this property to anyone in India. And what are the rent or income, being it is a current income, it can be repatriated abroad after payment of the taxes. So that is also permitted. Spouse of the foreign origin of NRI can jointly acquire the immovable property subject to certain condition, which there is not much rigorous condition. Any number of the properties he can acquire, there is no restrictions. He can hold 4 houses, 5 houses, 10 buildings, any limit of the immovable properties, land. There is no such limit on those numbers, and repatriate the sale proceeds of these properties within the limits prescribed. Now, what is not permitted for NRI for the immovable properties? He cannot purchase the agricultural land, plantation and farmhouses. That is the biggest restrictions. So they cannot acquire any land in all over India which is of the nature of agricultural land. Cannot do the real estate trading. Suppose if somebody wants to buy a land which is not an agricultural land and then he want to sell it as a business, real estate trading. If it is for the purpose of investment, yes, he can do, but for the business purpose, he is not permitted to do. Even he cannot hold the development rights. It means that suppose I purchase a land and then enter into an agreement, or a person, a resident who is having a land in India, I will enter into an agreement with them that yes, I will develop this and construct the complex over it, or develop this for the piece of lands. No, I am not permitted for this kind of the transactions, because this is again a business transactions which is not permitted. There are certain countries which are not even the citizens of those countries, even they are NRI, holding a means staying in India for more than 182 days, are not permitted to hold any immovable property except with the prior permission of the RBI. This is a very, very important thing, because normally what we feel that any person who come in India and stay for 182 days, he becomes NRI, even he is a foreign citizen. He can hold the immovable properties, that is a general exemption, he becomes a resident. No, it is not a case. We have to first verify where the citizenship of the person who is going to hold the immovable properties, if he is not an Indian citizen. So the certain countries, that is Pakistan, Bangladesh, Sri Lanka, Afghanistan, China, Iran, Nepal, Bhutan. So all these countries which has mentioned, they cannot hold any immovable property without the prior permission of the RBI. Yes, they can take these properties on a lease, but the lease period should be within the 5 years. Beyond 5 years, they are not permitted to hold the lease even. Remittance of the assets outside India. Suppose if any NRI who is holding the assets, whether he can be remitted back this to his foreign country. Yes, there are the certain transactions which are permitted. Now, first of all, we discuss the citizenship of the foreign states, excluding Nepal and Bhutan. So any person who is a citizen of the foreign country, but he is a resident in India, now he wants to remit the assets outside India, when he is going back to his country on his retirement of the employment, yes, he can do that. Any inherited assets if he is having in India, yes, he can take these assets back to the foreign. It is on repatriable basis. Person is non-resident widow and widower and receive inherited assets from spouse who was Indian nation. See, it is a case where suppose a spouse got died, a person whose spouse got died, but that spouse has inherited assets. Yes, those inherited assets being vested within him, he can remit this back to outside India. And the student who is coming in India on completion of his education, if he is going back to his country, the surplus money which he is having with him, that he can take back to his country. There is a no bar. Being all these kind of transactions are the capital nature, they are only permitted up to the 1 million per year. So these transactions are permitted up to the $1 million per year. Per year in the sense from April to March. He may take the $1 million at a stretch, or he may take the $1 million in a piecemeal way. But in a whole year, he is permitted for the 1 million. Suppose in the month of March, on 31st March, he is sending a $1 million. It is permitted, and again on the 1st of April, he can transfer the $1 million. Being this is the 2 years, he is permitted for those kind of arrangements and the facilities. NRIs and PIO, if any NRI or the person of Indian origin is there, yes, he can take from his NRI account up to the $1 million. Beyond $1 million, he cannot be permitted, but from the NRI account up to $1 million, yes, he can take it. From NRI account and FCNR account, there is no limit. And all these funds has to rotate through the one authorized dealer bank. You cannot choose a different authorized dealers. So that is the restrictions. And definitely tax payments, whatever is applicable to this transfers, these incomes under this account, they have to pay, and only the net amount is permitted to be taken back. This facility is available to NRIs. AD authorized dealer bank is allowed up to only $1 million. Balance in NRI account, sale proceed. This is only a summing up. Assets acquired in India by way of heritage and legacy. Under the deed of settlement of the families and parents, yes, that is also they can take it. On the death of the settler, yes, they can take it. In case of settlement is done during the lifetime of the owner and payment, transfer of the regular transfer of gift, remittance of sale proceed, this is also an account. This NRI and a person of Indian origin has to give a declaration before they take these assets back to the foreign. The first declaration they have given is remittance is out of the balance held in his account, and he has to permitted to take his own money. He cannot transfer the money from another's account and then he cannot take back. So the limit of 1 million, whatever is specified, is for his own money. If he is transferring the money from others account and then he is taking back, it is not permitted. He cannot borrow from any person, and the borrowing fund he cannot take it back to the foreign. And any another account, if he is having a 2 account, then he cannot shift the funds from another to another account and then take back. If he is having a 2 another accounts, from 2 another accounts he is allowed to take it. But yes, transferring he cannot do that. Now there is a case study on this. We discussed this. Mr. Ram, resident of US and person of Indian origin, has balance lying in his NRI account amounted to rupees 10 crore received from sale of his inherited immovable property. So he has sold his inherited immovable property, which is permitted, and he received the 10 crore rupees. Now he wants to repatriate this amount to US for buying a residential house in US. He is permitted to do so? Yes, he is permitted, because it is a capital nature transactions. As we discussed, any immovable property amount he is allowed to repatriate to the foreign, but there is a limit, cap is there, that is a $1 million in a year. $1 million, if you take it as today as a rate of 75 rupees per dollar, it comes to near about 7.5 crore rupees. Being it is a 10 crore rupees, up to 7.5 crore he can take it back to his account, because it is an inherited property. We will modify this case study again, and we say that this immovable property which he has sold is purchased by him by sending the amount from US in foreign currency. Then what will be the scenario? Amount remains 10 crore. Here we treat that when he has purchased this property, it is for the 8 crore rupees. He has sent in the foreign currency of rupees 8 crore, or we can say that 1.2 million or 1.1 million dollar. Yes, then also he is permitted, but he is permitted only to take the amount up to the amount which he has sent it from the foreign. that is up to the 8 crore rupees only. So remaining 2 crore rupees, it remains here only. And whatever the profit is there, he has to keep it over here only, and he has to wait for the another 1 year or the financial year to send it again up to the $1 million. Another case study is Mr. Steve, resident of USA, was employed in India by the Indian company for the past 10 years. So foreign citizen is employed in India. He retired from his employment. Now he wants to move back to the US. He has income lying in his saving account in India up to the rupee 1 crore. Now whether he is permitted to repatriate this 1 crore rupees to the foreign on his retirement when he's going back to US, yes, he is permitted to take this amount back from his another account, but only limited to the $10 million, being it is a very petty amount of a 1 crore. If you take a 75 rupees per dollar, he is permitted to repatriate up to the 7.5 crore, and being it is only 1 crore rupees, yes, he is permitted. Now we will go and discuss what are the loans and investment made by the NRIs, or the loans and taken by the NRIs and PIO. This transaction is also permitted for the NRIs and PIOs. They can borrow the loans. Any Indian citizen or any Indian resident can take a loan from the NRIs. So the recipient should be an Indian resident in India. They can borrow any amount from the NRI and PIO. The maximum limit of borrowing should be the USD of 2,50,000 in a year. So there is a cap on that. Borrowing is permitted within the cap. Who can borrow? Who can be a resident? Yes, there should be a close relative as defined in the Companies Act 2013. So only the 8 relationship, as we discussed in the Companies Act, are only permitted to borrow from the NRI account, NRI person. If there is any restriction on the use of the funds, there is no restriction to use of the funds. So they can use that fund as they wish in the foreign currency. Now, if it is we come to the Indian currency. Can any person borrow from NRI in Indian currency? Yes, if it is a direct loan acceptance, yes, they can do that. Here also the restriction is only up to the relatives, that is the 8 relationships, it is permitted. This fund is restricted to use Indian currency fund if they are using for the agriculture, plantation, real estate, construction of the farmhouse, trading in the time deposit receipts of the companies, nidhi investments or chit fund company investment in the markets, including margin trading and derivatives, that is a share market or the commodity exchange. No, from the borrowing from any NRI in Indian currency, they cannot use these funds for this purpose. Other than this restricted purpose, they are allowed. There is no other condition except these restrictions where they can keep a close watching. There is no cap on that. Any amount they can borrow in Indian rupees, subject to they cannot use the funds for the restricted activity. So where the companies can avail a loan from the NRIs, yes, from the ECB route, external commercial borrowing route, they can take it from the shareholders. If they are a shareholder, company can do that. Company can obtain a loan receipt number and complying with the ECB provisions. With this, if this is permitted and complying with the provisions, yes, company can obtain. Without the ECB route, companies are not permitted to borrow from NRI either in Indian rupees or in a foreign currency. Any investment in the Indian debt instruments, yes, they can do that. Other than the companies, any person can invest in this. Companies are not permitted. What are the permissible investments? They can invest into the government securities, unit of the domestic mutual funds, ETF investments, provided their investment should be less than 50% in the equity. Because once it is crossed the 50% of the equity, the debt mutual funds becomes a share equity debt, equity investment, where we are discussing only the debt instruments. So their investment in the equity should be less than 50%. They are permitted. Bond issued by the public sector units and the infra bond debt funds, they can invest in this. Listed non-convertible redeemable preference shares or debentures, they are permitted provided it is approved by the NCLT. Debt instrument issued by the bank within the bank norms, Yes, they can invest in that. Subscription to national pension scheme, yes, they can subscribe to the national pension scheme. There is no restriction on that. It is a repatriable and non-repatriable, both kind of a investment the person can do. Mode of the receipt is inward remittance should come from the outside India, NRI and FCNR account. It means that the fund, being it is in a foreign currency we are talking for, they are not permitted for the NRI account. So any investment, they can either bring it from outside India in the foreign currency, or they can make it in a NRI or FCNR account. NRI account is in Indian rupees, so they can do that, but only from the NRI account, not from the NRO account. If it is for non-repatriation basis investment, yes, all the three plus NRO account. So whenever we are discussing in the FEMA, if it is a repatriation basis, from NRO account, you are not allowed to repatriate the funds. If you want to repatriate from the funds from the NRO account, that is within the limit of 1 million under the liberalized remittance scheme only. Otherwise, you are not permitted. Any sale proceeds can be credited to the NRO account. Yes, definitely repatriation, if it is there, it can be credited to the NRI and FCNR account. But if you are crediting any amount to the NRO account from the sale proceed, you are not permitted to repatriate. If you want to repatriate, you have to take the benefit of LRIs. Now, can any resident lend the money to NRI? Yes, it is allowed with the restrictions. You cannot blindly give the lending to the NRIs. Lending by the authorized dealers in foreign countries. So any lending, if you go to the NRI in foreign country, it is through the authorized dealers, authorized bank, overseas branches. Otherwise, it is not permitted. So overseas branches of Indian bank can grant the foreign country loan to NRI against the balance lying in NRI and FCNR account. So it should be backed by the security. Security is in the nature of balance lying in NRI account and FCNR account. Lending by authorized person to in Indian rupees to NRI for his own requirements or business purpose. Yes, Indian loans can be in Indian rupees can be given to NRIs against the securities of shares, other securities as the bank deal free, against the security of immovable properties other than the agriculture, plantation and farmhouse. As we all know that agricultural lands cannot be mortgaged other than the agriculture purpose. The bank cannot give any loan against this property to NRIs, subject to the end use. So whenever the Indian rupee loan is given, there has to be a restriction for the end use of the funds, and any NRI cannot use these loans for the restricted purpose. As we discussed earlier, this 4 or 5 end use of the restrictions, all restrictions will be applicable if it is given in the Indian currency. Any loan given by the resident individual to the NRI relative. So if my relative who is NRI, can I give a loan to that person or not, even he is my relative? Earlier to ask the banking transactions. Now here we are discussing with the personal transactions from the resident individual relative to the NRI relative of the person. A resident individual may grant a loan to the NRI relative by cross-check, electronic transfer. Anyway, there is no restriction. The loan should be within the LRS limit. If it is in foreign currency, I can remit only up to the $250,000 and not beyond that. If it is in an NRI account, I can do that up to any amount. But yes, the restriction should be the fund which NRI relative is receiving, he cannot use for the restricted purpose as we discussed earlier. That is agriculture purpose, nidhi funds and trading. He cannot use these funds. But yes, for the business purpose other than the real estate business, he can use this fund either in India or abroad. Loan will be subject to the certain conditions which may be prescribed. As such, there is no major condition beyond what we are discussing. Now there is a case study on this. Mr. Akash, an Indian citizen, wishes to take loan from his NRI friend Mr. Prakash. Mr. Prakash has NRI account in India and intend to provide a loan to Mr. Akash for the period of 5 years and at an interest of 10% per annum. Mr. Akash intend to use the loan for the purpose of investment of capital of his partnership business. The partnership is engaged in the business of providing IT-enabled back office support service. Is he permitted to remit the funds? No, he is not permitted to give a loan, because from NRI account he cannot take a loan, or from NRI account he is taking for the business purpose loan, being it is not a restricted business purpose, it is falls under the definition, so it is to be for the restricted period of 3 years. He cannot take a loan for the 5 years, being it is given here for the 5 years, and the allowed period is only for the 3 years. This transaction is not permitted. And if it is beyond 3 years, suppose if we say change this 5 years to 2 years, yes, he is permitted to take the loan or give the loan, but up to the 2,50,000 USD. Another is security deposit given by the NRI to the resident. Mr. XYZ is the NRI who wants to take a premises on a rent in India. Indian resident landlord desire to give a property on the rent, ask for the refundable interest-free security deposit from NRI. So whenever we go for a property on a rent or the lease, we know that the landlord asks for a certain amount of the deposit. Whether the NRI is permitted to give that security deposit to an Indian party, yes, as we already discussed that he can take any property on a rent with a subject to certain restrictions, that it should not be beyond 5 years lease, he is permitted, and he can give the deposit within the criteria as prescribed in this. So being he is giving if he is giving from the NRI account, there is a limitations. From NRI account there is a no limitations. Borrowing and lending in NRI in Indian rupees. XYZ is the NRI director of an Indian company, XYZ Limited. So Mr. XYZ is a director in an Indian company. XYZ Limited wants to obtain a loan in INR from its director. Can they obtain that? If it is giving from the foreign, no, he cannot take. If it is from the NRI account, yes, he can give that loan within the prescribed limits. And Indian rupees, no, sorry, he cannot take it, because any Indian company, if you take as a loan, it has to come through the ECB route, external commercial borrowing routes. By complying the external commercial borrowing rules, if those rules have been complied, yes, XYZ Limited can take a loan. So till that we have discussed about the debt instruments or the loan and investment transactions. Now we discuss whether the NRI is permitted to invest into the equity investment. Yes, they are allowed to be invest in the equity investments. Number one is on a repatriable basis, another is on non-repatriable basis. Both way transactions is allowed subject to conditions. Number one is the equity instruments of a listed Indian company. Yes, other certain securities which are defined under the Schedule 3, they are permitted. On non-repatriable basis, yes, equity in a listed company they can invest. Along with that, they are also permitted to invest into the LLP in a partnership firm or in a proprietary firm. If they want to invest in this as equity, yes, they can invest. Other securities as defined under Schedule 6. Another one is Indian depository receipt of a company residing outside India. If suppose if any company outside India is having a IDR or the ADR, yes, NRI is allowed to invest in that investment also. Now, what is the Schedule 3? That is the repatriable basis we are discussing. What type of the investments are allowed on a repatriable basis under the Schedule 3? Equity instruments in a listed company, it is allowed. There is a cap. There is a cap in the sense that the Indian company who is taking an investment from the NRI should look into that the whole up to the 5% of the diluted basis capital or the preference capital they can take from the NRI. That is the permitted. 10% can be increased up to 20 with the special resolution. With the special resolutions, in case of all NRI, so that is the individual cap of 5%. If one or more NRIs are investing, the cap is 10%. This 10% cap can be increased with the general body resolution up to the 24%. So company has to take care of this issue. Yes, individually you can invest up to whatever amount you want in the different companies, but one company cannot go beyond the cap which is prescribed under the Schedule 3. If it is to a mutual funds, there is no cap limit. To mutual fund, person can invest up to any limit, but mutual fund has to see that the investment should be more than 50% in the equity. The scheme of the mutual fund where they are investing, that scheme should have a more than 50% investment in equity, otherwise it fall under the debt instrument, and once it fall under the debt instrument, the rules of debt instrument will be applicable. So this is the mutual fund which has to look into that, or it is basically an NRI has to take care of these things, in which type of the funds he has to invest in. Shares of a public sector enterprises, yes, there is no limit. They can invest up to any kind of limit of the public sector enterprises. Share being distributed by the central government, it is permitted because the central government is issuing the shares, and the terms of the bid wherever the public sector is giving is as per the notice. Beyond that, if any restrictions or any conditions are put up by at the time of invitation of the bid, person has to look into those kind of restrictions or the conditions. NPS, National Provident Pension Fund, yes, any NRI can invest into the national pension funds. If it is a non-repatriation basis, again it is allowed under the Schedule 6. NRI can or the OCI can invest. Company or trust or firm incorporated outside India, they can invest in that. Owned and controlled by the NRIs. So here earlier this is not permitted. On repatriation basis, it is not permitted. Only individuals are permitted. But on non-repatriation basis, companies or trust which is incorporated by the NRIs in the outside India, even they are also permitted. In the mutual funds, same condition. There is no limit, provided it is the investment funds. Investment in the firms and proprietary concern, yes, they can invest, but the firm or the business activity of a proprietary concern should not engage into the prohibitory activities. What are the prohibitory activities? As we earlier discussed, is the same kind of activities. Nidhi company engage in the agriculture activity, real estate, constructions. These are the restricted activities for all kind of transactions. Investment in the debt instruments. Yes, FEMA Debt Instrument Regulation Act controls this and provide the eligible debt instrument. That is again is a summary of what we have discussed earlier. So we are not touching upon this. On the basis of repatriation and non-repatriation basis, they can do it. Here, yes, on non-repatriation basis, we can discuss that. In the national pension scheme and saving certificates, they can invest. There is no restriction to invest in these funds, provided it is on a non-repatriation basis. Now, what are the general do's and don'ts which the NRI has to keep in mind when he is dealing with the investments and all? The most important thing which the person has to, or a professional like us, when we are advising to our clients on the investments and the foreign transactions to NRIs, we have to understand the basic definition of a person resident in India and person resident outside India. So these two things, person who is resident in India and person who is residing outside India, there is a very thin line to decide who is NRI and who is not. So that distinction one has to be understood very clearly. One has to be clear about what is the current account transactions and what is the capital account transaction. As Mayur sir has already described these two things in detail, each and every point has to be considered when we are advising to our clients about the investments and the transactions by NRI in India. Inform about the respective person of the change of a residential status. As soon as the status of NRI is changing to the resident, it has to be informed to the respected persons, respective authorized dealers, bankers, that yes, his residential status has changed and that proper change has to be effectively entered into the system. Otherwise, it may create a problem, and penal action or penalties can be levied under the FEMA. One has to keep a track from the rupee fund in India and the fund remitted from India, because there is a restrictions, there is a cap on the investments if it is happening in India and outside India, if remitted. So one has to keep a track for the whole year, because the limit is on a whole year basis and not on a each transaction basis. One has to understand the sale proceeds about the immovable properties and understand up to what limit he can be repatriate, because the whole amount of the sale proceeds is not allowed to be repatriated outside India. So one has to understand the transactions and the limits prescribed for the sale of the assets for those transactions. One has to comply with all kind of statutory guidelines for the investment and repatriations, and file certain forms and declarations as given in the ABR and FATCA. FATCA is basically for dealing into the securities and derivatives. So all the statutory guidelines, whatever they prescribed by the government from time to time, and declaration which is to be submitted to the authorized dealer has to be submitted before taking the transactions. They have to give a power of attorney for all Indian matters to the trusted persons. Power of attorney is a very, very important instrument or a document where a person will transfer his rights to exercise by another persons in his absence. So this is a very good kind of a document where without presenting himself physically in India or to a particular transactions, he can give the power of attorney to a trusted person who can carry out the transactions on his behalf. But yes, anything done by the power of attorney holder will be within the limits as prescribed. If he broke or if he pass out any transaction which is not permitted, the person is equally liable, that because that NRI person is equally liable, because all the transactions are done on his behalf. So one has to be very, very careful when he's giving a power of attorney. Follow custom baggage rules for movable assets when transfer of residence. There are the certain benefits under the custom baggage rules given to NRI whenever they are coming or going back from the India on shifting or an employment basis. There are the certain advantages. They are permitted to import and export or carry along with him certain assets. That is the benefits they have to take it, because if suppose any NRI who is coming in India with a certain percent of gold, I think it is a half a kg gold, which in recently has been increased to 1 kg. If he is bringing, he is allowed to bring it. Yes, definitely he is allowed without any custom duty. So there are the certain benefits which he has to understand the baggage rules. They can take out the benefit of the overseas citizen scheme, accept rupee gifts from only the close relatives. Beyond the relatives, 8 relatives relationship, he should not accept any kind of a gift, whether in kind or in Indian rupees or a foreign amount. In India, he cannot receive that. He can gift the amount in NRI or in Indian rupees, even in the foreign currency within the limits, to the relatives and non-relatives. If it is in Indian rupees, he can give it to anyone. There is no restriction, but yes, from his NRI account, he can give it only to the relatives. What he is not supposed to do. Earlier we have discussed what he can do. Now what he cannot do. He cannot execute the capital account transactions which are prohibited. Any capital transactions which is not permitted or which is prohibited, he should not carry out that transactions. So he has to understand what is the capital account transactions. Any current account transactions which are prohibited. Normally this is not prohibited, but yes, any current account transactions are permitted only to a certain limits for the certain purpose. For certain purpose there is no limit, so within that limit he has to do that. Beyond those limits as prescribed for those specific activity, he cannot do any kind of current account transactions. Instruct resident to make onward payment on his behalf. So any resident who is acting on his behalf, on that is a power of attorney holder, should not carry out any outward payment except for the medical expenses, boarding, lodging, and traveling within India. So any power of attorney holder can do his day-to-day activity which is required in India, but any outward payment outside India, he should not exercise his right. He has to be restricted for that, because outside, if he want to remit anything, that has to be remitted by the person who is himself. On POA basis, power of attorney basis, no amount can be remitted by the power of attorney holder. Netting of the transactions with resident, any transactions which is carrying out, it means that netting of transaction means that if suppose a person has invested a fund or given a fund to a person of rupees 1 lakh in the deposit account, on the other side he has purchased the goods from the person for the 2 lakh rupees. So net amount which he has to pay is 1 lakh rupees. He is not permitting to net off this amount. It means that on the one hand he has to receive 1 lakh rupees, and on the other hand he has to give back the 2 lakh rupees. He cannot say that I am netting off and I am paying only the 1 lakh rupees. So netting of the transactions is not permitted in the FEMA. Be careful both for those kind of transactions. Receiving gifts of immovable property from the resident relatives is not permitting. He cannot receive a movable property gift from the resident unless until it is specifically and expressly allowed, which is allowed is only from the 8 relatives. Beyond 8 relatives as prescribed in the Companies Act, 8 relationship, he cannot receive any movable or immovable property as a gift from any other person. He cannot open, renew, and cannot additionally contribute to the PPF account in India. It means that before he becomes an NRI, whatever the PPF account he has opened, he can continue and maintain that account. He can invest in that account. He cannot, suppose that 15 years is completed, he cannot renew that account. If he is opening, and he can, after becoming an NRI account, he cannot open a PPF account, and any additional amount beyond the permitted limit he is not supposed to invest into the PPF account. He has to check the eligibility for the Aadhaar, whether he can continue with the Aadhaar or not. One has to be careful. I think he is not allowed, any NRI who is not permitted to carry the Aadhaar. So he has to change his status under the Aadhaar. He cannot accept the cash gift in NRI and foreign exchange account from any person, permanent resident of India, allowed only through the banking channel and within the limit of LRS. Cannot borrow from the resident relative in foreign currency even under the LRS scheme. So NRI cannot accept any, cannot borrow the loans from the relatives in the foreign currency. Now there are the general frequently asked questions. We discussed those in a quick manner. I think we still have 15 minutes. So I think I will be within a time to finish those. See, first of all, the first frequently asked question by the persons or the consultant is, when a resident become an NRI, whether he has to change his bank account or not. We know that whenever the NRI is coming and his status is changed to resident, he has to inform immediately. Similarly, here also, when a resident become an NRI, he has to inform immediately to the banker and change his status in the bank from the saving accounts to the NRO account or the NRE account, whatever status he wants. He has to change that account status immediately. There is no ambiguity about it. Another thing is, what is the meaning of investment on repatriation and non-repatriation basis? This is a very, very important question, because one has to understand what is called as a repatriation and what is called as a non-repatriation. Repatriation means that a sale proceeds, profits, or any income which is eligible to be freely remitted outside India. It means that if I have to take back the investments or the sale proceed or any amount outside India, whether it is coming from outside India or within the India, it is called as repatriation. means any fund which is going out of India is called as a repatriation. What is the meaning of a non-repatriation? Non-repatriation means the investment made by the NRI which cannot be freely remitted outside India. So any non-repatriation means, amount of non-repatriation means that amount you cannot take back outside India. If you want to take back this investment or this amount back to foreign, then there is some restrictions. By complying and within those limitations and complying of those procedures, only you are allowed to take the funds back. So there is a very clear-cut things. When there is a restrictions, it is called as non-repatriation. When it is a freely transferred to the outside India, it is a repatriation. What is the scheme available for making remittance from India to foreign country? Yes, there is no bar that you cannot take the funds outside India. You can take any fund outside India, but within the limits. There is a free hand given by the government. Up to the certain dollars, it is permitted to take outside India. That is up to the $1 million. Any person can take it, any NRI can take it from his non-repatriable investments, from his NRO account, or the restricted sale proceeds, or any capital investment, capital transactions. Up to $1 million, person can transfer this to the foreign without any permission from the RBI. Yes, beyond $1 million per year, if he want to take, he has to take a RBI permission. So that is a limit cap. Within that limit, it is permitted. Can NRI invest in the shares and mutual funds on the Indian stock exchange? Yes, it is permitted. He can buy and sell the Indian shares, mutual funds, exchange, open a demat account. But yes, when he is opening a demat account, it has to be linked with the NRI account. It means that it should not be linked with the NRO account or any Indian account. The account should be linked with the NRI account. With this limitation, yes, he can do it. Whether he can invest into the initial public offer, yes, it is permitted to be invest into the Indian public initial public offers, but subject to that investment has to be approved by the competent authorities at the time of public issue. Can NRI make direct investment in the shares of an Indian public company or a private company? Yes, NRI can invest directly into the Indian listed and non-listed company, subject to the conditions and obligation. As we said that NCLT has to approve if it is for the non-listed or the private company. Yes, he can invest. Can NRI continue his LIC, medical insurance and other insurance policy after he become a person resident outside India? This is a very important question, that because we know that many persons are going outside for the employment and a business purpose, not with the intention to settle over there. Yes, they can continue whatever the policies they are having in India. Before becoming an NRI, they can continue and they can invest in those and paying their premium. Can NRI borrow money from his resident relatives? That is a very, very important question, because if I am staying outside India or in India, can I borrow from my relatives of the resident? Yes, up to the limit of 2,50,000 USD, one is allowed per year. But beyond $250,000, no, I'm not permitted. That is an upper cap which one has to keep in mind. But this limit is for the per person, not as a family. It is not for NRI. Suppose there is one NRI is having 3 brothers. He can borrow 2,50,000 from all the 3. So total he can borrow 7.5 USD. So that is a per relative in a year. So it is not a per NRI. Such borrowing have to be deposited into the NRO account. So NRI deposit is not permitted. It has to be go into the NRO account. Further, the proceed of the sale load cannot be remitted outside India. Amount cannot be taken back to the foreign. It is not a free remittance. Relative is defined, as I told you, that it is the 8 relationship. Yes, member of a HUF, he can borrow from them. Suppose there is my grandfather HUF is there. We know that once it is a grandfather HUF, grandfather, grandmother, his sons, his daughters, their children's, everyone fall under this, and you NRI is also a member of that HUF. By extending the scope in that manner, yes, he can go and borrow from the relationship which is beyond this 8 relationship. In my opinion, he is allowed, because the HUF concept is a very bigger concept. If I am a member of my grandfather's HUF, I am permitted from loan from this, and they fall under the definition of relative under the Companies Act. Another important question is, can NRI receive any gift from his resident relatives in Indian rupees or even foreign currency after he become a resident outside India? Gift is a common thing, as we know that in income tax also the gift has been given a benefit if I am taking it from a certain persons who are my relatives. FEMA also allowed to take the gift from his relatives in Indian rupees as well as in the foreign currency, but the limit is always prescribed under the LRS scheme. It is up to only the 2,50,000 USD if it comes in the foreign currency. Gift received in can be deposited in another account. All gifts should go into the another account, and from another account up to the $1 million account dollar as under the LRS scheme can be remitted, considering in the totality. It is not only a gift up to 1 million. All the transactions together, it should not cost the $1 million. So all my sale proceeds, all my gift receipts, all my current transactions, all my rent receipts, whatever I have in another accounts, taking all together, it should not cost $1 million in a year. Can NRI continue his investment in PPF account, NSC accounts after he becomes a resident outside India? Yes, he can continue to invest in the PPF and NSC account, but yes, definitely on maturity he cannot continue and renew this PPF accounts or NSC certificates. Can NRI continue loan given to resident while such NRI was a resident? Any amount which a NRI has given a loan to a resident, can he continue to be given? Yes, he can continue with those loans to be given to the resident and receive any interest and income on those investment. Yes, once the limit is over, he cannot renew this. Renewal will come under the limitations as permitted in the FEMA. Beyond those, he cannot renew. So after NRI, restriction will be allowed. Before that, any investment which he has made as a loan to the any person in India, that is allowed. Can NRI continue as a partner in the Indian Partnership and NLP? Yes. Before he becomes NRI, there is no restrictions on the entering into the partnership and NLP as a partner. He can continue with that status. There is no change, and so he is permitted to carry that status. Yes, but if you want to have a fresh investment as an NRI in the partnership firm or LLP, that should be on a non-repatriable basis. He cannot repatriate the investment back. Can NRI acquire the immovable properties in India? Yes, he can purchase the immovable property in India, except the agricultural land, farmhouse and a plantation properties. Even he can acquire the properties on a gift from the resident, on a gifts from the relatives. After NRI return to India, can he still continue to hold his bank account, investment and properties in the foreign currency? In the foreign country, suppose if NRI is coming back to India on a permanent basis, can he hold his foreign investments in the foreign country? Yes, he can continue as a investor in the foreign currency in India or abroad. There is no restrictions or there is no compulsion to bring back those funds to in India. Now the most important thing is, at last one, we have discussed here that what he has to do, what he has not to do, but it is very important to mention that if he fails to comply with any regulations and rules as prescribed in the FEMA, what are the penalties and what are the consequences for those non-compliances? See, the first most important is the penalties are very heavy. It is not a small amount. The first one, it has to be understood that if it is it can be quantified in the amount. any transactions which he has violated, if it has been quantified in a rupee term or a dollar term or in absolute term, then the penalty is the 3 times of the sum, 3 times of the amount which is involved for such contravention. The penalty is 3 times of that amount or quantified amount. That is a big one. One has to be very careful because normally all kind of transactions are quantifiable when it's routed in Indian rupees from the foreign country to India or India to foreign. Another penalty, if suppose it cannot be quantified due to some reasons, which may be a procedural kind of a thing, one compliances. Suppose when I am coming back to India, if I am not changing my residential status, there is no quantification of the amount involved. In that kind of a situation, the penalty is up to the 2 lakh rupees. It depends on the authority and the result consequences for those non-compliances and the benefits which you have availed or by non-disclosing or non-complying with the provisions. So looking to the seriousness of the transactions, it may go up to the 2 lakh rupees. And this is not only the 2 lakh rupees or so, 2 lakh rupees or so, but if this failure, as I told you, that non-disclosing or non-changing your residential status in a bank, it is a continuous default till, suppose if today I have come in India and I have not informed my banker about it, and up to the 2 years, if I am not informing my banker about my change in the residential status, it is a continuous default, and for each day my penalty is increased by 5,000 per day. So suppose if for 300 days, if I am not disclosed, my penalty becomes 15 lakh rupees plus 2 lakh rupees. So per day penalty it is levied, and which is a very hefty amount. So being a professional, we should be very careful when we are dealing with the NRI accounts and understand those kind of transactions. With this, I am concluding my presentation, and thank you very much. If any questions, I am here to answer. Sir.
Sir. Yes, sir. We have some questions, and if time permits, we'll take 2 or 3 if they are not answered in FAQs. So, ma'am, can we take 5 minutes maximum?
Ma'am, you are mute.
Ma'am, you're not muted, but you're not audible. It seems this thing is not plugged in properly. Microphone. No, you're not audible now. Can I check your external microphone is connected or something? In the meanwhile, if possible, we'll take up the questions, sir. There are 4 5 questions. If those are not answered in FAQs, we'll take it up. I'll share my screen.
It was mentioned that only close relatives can gift under LRS. How can a resident Indian gift in INR to his NRI friend? What is the permissible route? Sorry, sir, any resident cannot give any gift to any NRI friend. It is only allowed up to the relatives. Beyond that, it is not allowed. So the person, NRI friends, cannot take any gift from any other than the resident person. What is the position of resident, non-ordinary resident having his overseas income from overseas assets? Can he continue to be NRI account till the period he become a normal resident? Yes, he can continue with his NRI account. There is no bar on that. Advance made to foreign suppliers are not getting settled during the current crisis. Advances made to foreign suppliers are not getting settled during this current crisis. Any restrictions under the FEMA? Yes, it is restricted because it is a business transactions. Normally NRI is not following. Restrictions are prescribed within the certain limits. They have to settle their accounts. Because in current crisis, I think there is no liberalized kind of a thing or a facility has been given. They have to take a permission for extending the time limits. profit on sale of properties cannot be repatriated even if it is within 1 million. No, it is allowed, subject to the transactions. All the investment should be purchased, inherited. Any profit is allowed. If it is within 1 million, it is allowed because it is under the LRS. It is allowed. Can an OCI repatriate his share in the sale proceeds of his family property in India? Can an OCI repatriate his shares in the? Yes, he is allowed because it is inherited and a joint property. It is allowed. What about purchase of agri land by a company where most of the shareholders are NRI? See, most of the shareholders are NRI. There is a limit. So any company cannot have any investment from limit of the NRI. Only up to the 10% of their capital they can take it from NRI, or with the special resolutions or board resolution, it can be increased up to 24%. So beyond 24%, there cannot be any holding by the NRI. So that is a limitation over there on the company. Yes. Can an NRI who inherited vacant land from father enter into a joint development agreement with the developer? Yes, he can do that. There is no restrictions, but he cannot make a trading. It is his inherited property which he is giving for the development to a JDA on a fixed amount, but being he's doing that is permitted. I don't feel there is any restriction on that because it is an inherited property. And NRI got rupees 20 lakhs as advance towards sale of land in India. Can be repatriated this amount? Yes, within the limit of 1 million and the restrictions, he can do that. If the consideration for the issue of shares is received in compulsory convertible debentures at premium, if the consideration for issue is received in compulsory convertible debentures at premium, should we get valuation report now or at the time when the CCDs are converted to the shares? I think when this type of the transactions are happened under the Companies Act as well as under the Income Tax Act, the company has to take a valuation report and give the basis of the conversion. That I think is sufficient. No need for going for the separate valuation. In case study 8, loan from NRI friend is permitted, but in previous slide mentioned as permitted only from a relative. Case study 8, it is in the Indian rupees and non-repatriable basis. It is permitted. Previous one is in a foreign currency, so that is allowed. Can an NRI green card holder resident in US buy the equity share directly from a shareholder of a private limited company by remitting the amount in US dollar to the shareholder who is ready to transfer his shares at an agreed value? Yes, it is allowed. There is no restriction on that. If an NRI, but yes, when he is to sell back, it is within the limitations. Sir, if an NRI does not change his saving account to another NRI account as it was his Indian salary account and was on employment abroad, he changes, but why he want to change? I can't understand this question, because when he's continue to NRI, I think there is no need to change his NRI account. His saving account, he has to change to another account. All accounts has to be changed. Once he becomes NRI, all account status has to get changed, sir. In the last question.
Yes, sir. Thank you, sir.
Yeah.
Those were the questions that is compiled. Ma'am, over to you.
Ma'am, sir, am I audible, sir, now?
You're audible now, ma'am, clearly. Over to you for what?
Yeah. Thank you so much, sir. That was quite an enlightening session. So I think more the points, I think most of the points Mayur sir, the initial points were covered by Mayur sir, but we could say like so many intricate points, especially relating to that immovable properties, restriction with respect to immovable properties and the repatriation, the do's and don'ts. I think these are the questions we normally get from the clients also. So I think the members would have surely benefited from the session, and especially taking your time for analyzing so many case studies and FAQs. I think probably they would have reduced the number of questions because you would have explained the FAQs very beautifully. So thank you for taking up the MCQs and even patiently handling all the questions given out by the members. Thank you so much, sir. We expect to see you soon in Chennai for another session. So thank you so much, and thank you, Selva and Monica, for the proper coordination.
Thank you. Thank you. The close of the
Thanks a
session.
lot.
Thank you. Thank you.
Thanks a lot to everyone.
Thank you.
Thanks a lot.